Very good evening, students. Good evening to all of you. Radha, good evening. Kanaya, very good evening. So now, students, today we will proceed on the capital gains particular part. Lakshmi, Muskan. So, students, we will start today on the capital gains particular part. And on the buyback front, students, yesterday you people have, on the last lecture, students, you people have already have seen in the context of the amendment of the buyback, the additional tax that is now being imposed. Imposed to whom, students? Imposed to the promoters. We have seen that in this context. And we have also seen, students, in this case that there is also a flat particular surcharge that is imposed. We have not only the additional tax, but also there is a flat surcharge. Now, this flat surcharge, students, tell me quickly. Let me see how many of you would have revised it. That flat surcharge, is it on the entire tax or only on the additional tax? That flat surcharge that has to be imposed on that buyback tax, Kanaya, is it only on the additional tax on buyback or it is on the entire amount of tax, Radha? Is it on the additional tax? Flat surcharge of, what is the rate of flat surcharge? 12%. 12% is the rate, students. Isn't it? So, therefore, that 12% of the rate of the flat surcharge, you have solved the questions also on that, isn't it? So, in this regard, students, quickly, this surcharge, students, which is also been clarified by the Income Tax Department in 26th March 2026, rather in this case. And what does it say? The flat 12% surcharge applies only to the additional income tax payable by the promoters. Is that point clear to all of you, students? Every one of you? Lakshmi, Radha, Kanaya? Perfect. Great. Apart from this, students, I have also told you, if you recall, I told you some way of deriving this rate, how to remember this rate. One trick I told you in the last lecture, the trick to remember this rate, isn't it? For if the promoter happens to be the domestic company, I told you the base rate for the domestic company, students, under the alternate tax regime is how much? 22% in this case. So therefore, 20% is the 20%, students, is the ordinary rate of tax, and plus 2%, students, becomes what? The additional tax that you are supposed to pay. But who will be paying, students, the additional tax? Only the promoter. Okay. Whereas if it is a non-promoter, like for example, I gave you my example, I'm a non-promoter of Reliance Industry and Reliance Industry happens to do the buyback. In that particular case, I will be subject to the I would be subject to, if it is a short-term capital gains, then I will be subject to, students, what is the rate? 20%. This is for the short-term capital gains. 20%. I am a non-promoter, no additional tax. Okay. What if it is a long-term capital gain, students, then? For a long-term capital gain, students, in this context, so check out. There are two long-term capital gains can happen. I gave you the example also. If it is a equity shares listed in the recognized stock exchange on which the STT has been paid, then we know, remember that section 198, what is the rate? 12.5% in excess of rupees 1.25 lakhs. In excess of rupees 1.25 lakhs. I told you already about that, isn't it? So what is the normal rate of tax? Students, what is the normal rate of tax? Please tell me. The normal rate of tax, students, is 12.5%. And how about the additional tax, students? What about the additional tax? Additional tax, I told you, is about 9.5%. 9.5%. Now, this 9.5% would be only if the promoter happens to be a company. Only the promoter, students, happens to be what? The company. This is what we discussed last lecture, isn't it? Because for the company, what is the target, students? By virtue of the additional tax, what is our target? The target is that if the promoter happens to be a company and it is a long-term capital gains in the nature of 198, then apart from the ordinary tax at 12.5% in excess of rupees 1.25 lakhs, the promoter domestic company will also be liable for the additional tax on that buyback. And how much is a buyback additional tax rate? 9.5%. So I told you 12.5% plus 9.5%. How much is that total amount? 22%. What about if the promoter is other than a company, students? Then if the promoter is other than the company, short-term capital gains rate 20% any case. But now what is the additional tax? I told you for the other than the promoter, sorry, other than the domestic company, like for example, like an individual, students, like an individual, I am an individual. So if supposedly I happen to be the promoter of that particular company, I happen to be the promoter of that particular company. Now you tell me, students, in that particular context, if I happen to be a promoter of that particular company, the applicable rate for me, students, would be indeed 20% plus the additional tax would be 10%, because I gave you the logic trick. 30% is the base rate. The 30% happens to be my base rate. And therefore, 20% anyway short-term capital gain is taxable under section 196. 20% any case, the short-term capital gain is taxable under section 196. Plus you top up with 10% more. Therefore, that will become 30%. If it is 198, then students, for me, if it is 198, students, tell me, 12.5% is the base rate in excess of rupees 1.25 lakhs. 12.5% is the base rate in excess of rupees 1.25 lakhs. All of you agree? Perfect. Very good. And now, what would be my top-up rate? Students, what would be my top-up rate? The top-up rate would be 17.5% to 12.5 plus 17.5. I already told you the base rate for the individual would be 30. So therefore, the additional tax rate would then become 17.5%. Now let me also ask you this question once again. Let me see how many of you are revising and all on your own. Students, this you all are aware that under 198, the ordinary tax is at the rate of 12.5%. And that 12.5% is in excess of rupees 1,25,000. 1,25,000. So students, now you tell me, all of you, that the additional tax that is going to be imposed, the additional tax, students, that is going to be imposed, will that also be on excess of rupees 1.25 lakhs or on the entire amount? Whether the additional tax, students, at 17.5% when the promoter is not a domestic company, or when it is a domestic company, then the long-term capital gains under 198 for a promoter domestic company, students, it is 9.5%. So in this case, what is my question? Again, I'm repeating to all of you. My question is whether that particular additional tax at 9.5% or at 17.5%, as the case may be, will it be on the excess amount, that is beyond 1.25 lakhs, or it will be on the entire amount of the LTCG? Indeed. Very good, students. So this is what it is. The answer is it is on the entire amount of the LTCG and not just restricted to the excess over and above rupees 1,25,000, and not just restricted to an amount in excess of rupees 1,25,000. Is that point clear to all of you, students? Every one of you? The best thing was that, students, on the amendment, this particular heavy amendment that was done, on that we solved that question also. And please mark, students, generally amendments primarily are important from even examination point of view, and this section per se is an important particular thing which has been there. Okay, from examination point of view also, this is a very important particular point which you always should keep an eye on the various amendment. Then we have solved this particular question, students, on the buyback. And now, students, I will proceed to my next segment. Shall we proceed now, students? Everyone? Perfect. So in the last session, students, if we see, students, in the last session that we have discussed, we have discussed, students, we are in the discussion of the capital gains in the context of various case of the business restructuring. First of all, we started off with the definition of capital asset. Capital asset means the property of any kind held by the SSE. Property, students, means what? Legal exclusive right. Now, of that property, there are certain exclusions. Of that property, there are certain inclusions. Exclusion notably are stock and trade, rural agricultural land, movable personal effects, but excluding certain items, which is jewelry, work of art, paintings, drawings, sculptures. So these are excluded from the movable personal effect item. So exclusion on the exclusion, I told you, exclusion on the exclusion will be an inclusion. So therefore, this particular category, the specified exclusion, are to be considered as what? As the capital asset. What are the specified exclusion to the movable personal effect? Jewelry, work of art, drawing, painting, sculpture. So therefore, they are the capital asset, isn't it? After that, there were certain bonds which were also there, which are excluded from the definition of capital asset. After that, students, we entered into the definition of transfer. And in the definition of transfer, students, be careful. What is that we have seen? Sale, exchange, relinquishment, extinguishment of rights. Then certain special cases of transfer also we discussed. Conversion of capital asset into a stock and trade is also defined as a transfer. Also, students, compulsory acquisition by law is also defined as what? As a transfer. And there are a couple of real estate cases also, special case of real estate transaction, which is also defined as a transfer. But for that, I will be discussing in a separate category of capital gains implication on a real estate transaction. We'll keep that as a separate category. After this, we will discuss that category on real estate. Then, students, I also told you that not all the transfers, students, not all the transfers are considered as a taxable transfer. Even that point I highlighted with all of you. And then I told you, students, in this context, what did I told you, students? Not all the transfers, students, not all the transfers is considered as a taxable transfer. Isn't it? Not all the transfers are considered as a taxable transfer. Students, can you tell me which section number? In which section number? Indeed. Can anyone tell me right now, Kanaya? Kanaya has answered it. Can anyone tell me, students, under which particular section number they have said that these particular transfers will not be considered as a taxable transfer? Quickly, students. Radha? Under which section? Subsection clause, let it be only section number will be sufficient. Yes, I am. Okay, Radha, do remind me today your query towards the end. Okay, that subsection part, I think that is the query you are asking. So today, just remind me, so I'll just ensure to address that particular part. Can you? Indeed, very good, students. Very good, excellent. So it is quite nice to know that you are aware of these propositions, which means that you people have revised it. So students, in this context, yes, indeed, section 70 tells you that look, these particular transfers will not be considered as a taxable transfer. These particular transfers will not be considered as a taxable transfer. So we do have a proposition to that effect. Okay. But now again, one query I am asking, students, again, one query I'm asking to all of you is, we know that the charging section under the head capital gains was under section 67. Then there is section 68 for liquidation. Then there is section 69 for buyback. So my question to all of you is that the exemption or section 70 coverage of the exemption, is it applicable to all the three charging section, 67, 68 or 69? Or it is restricted only in respect of the chargeability which is attracted under section 61? What is your answer? Is the exemption of section 70, does it extend to all the three charging section, or it is restricted only in respect of the chargeability under section 61? Quickly, students, if you answer this, it means that you people are really are grounded and revising. Tell me quickly. These are advanced level interpretation students. From way back from 2011, double AR started giving the decision in these particular matter. Indeed, Radha, Kaniya, Lakshmi, very good students. Excellent. It is restricted only on section 67. It does not extend to the other chargeability, which is 68 and 69. I hope that every one of you are clear with this one. Perfect. Very good. Excellent, students. So now, students, what we were discussing in the last lecture, students, we were discussing about certain case of business restructuring in this context. And what we have discussed majorly, students, in the last session was about, say, liquidation of company. What happens if there is a liquidation of company family, and on that account the asset is required to be transferred? We discussed that. In fact, students, remember, we discussed not only the capital gains implication on the liquidation of company, but we also extended our coverage to the head IFOs as well. Dividend. Remember? Remember that, students. On liquidation, if there is any distribution that is made by the company, you will have to create a first charge under the head IFOs. Under the head IFOs. IFOs in the hands of the shareholder. So whatever is the distribution, I am a shareholder, and on liquidation of this company, I am receiving the amount. I am receiving the amount from the company. Then that amount which I have received from the company, the first charge will be attracted under the head IFOs. The first charge would be attracted under which head, students? Under the head IFOs. But whether the entire amount that you have received, will that be charged under the head IFOs as a deemed dividend? Please tell me, students. I need an answer for this. If you are answering these things, students, your understanding indeed has gone to the advanced level. My question again, I'm repeating. What I have received from the company, on liquidation, whether the entire amount which I have received from the company on liquidation, will that be considered as a deemed dividend chargeable in the hands of the shareholder? Is my question to all of you. Kariya. Indeed, rather, only to the extent of the accumulated profit of the company, only to the extent of the accumulated profit of the company, only to that particular amount, it will be considered as deemed dividend. Very good, students. And tell me if you have answered this. My last question before we start now the day with the new particular segment. My last question, students, to all of you is, okay, if supposingly I have received from the company, say rupees 100, okay, I have received, the share of accumulated profit in that 100 was say rupees 40. Now the balance 60 which I have received from the company, What I am going to refer that 60 as, I'll give you two options. Option number one, that balance 60 will be referred as a full value of consideration. Option number two, balance 60 will be referred as what? As a capital gains. What you are going to say balance 60 as full value of consideration or capital gains? Think carefully, students, and I want a correct answer from you. We balance 60 will be referred. Karaya, be careful. I'm giving you an option, students. The balance 60, will that be considered as a full value of consideration or it will be considered as a capital gains? What it will be considered? So this is the last question before now we start with the new segment. Let me bring down. Radha, can you quickly? Indeed, students. Very good. Very good. 60 would be referred as what? As a full value of consideration. Excellent. 60 would be referred as what? As a full value of consideration. And from that 60, students, I will reduce the cost of acquisition of my shares. The cost of acquisition of my shares, students. I'm a shareholder computing the capital gains. So for me, the full value of consideration will be 60, not the entire 100. Why? From 100, the first charge goes to the head IFOS, but not the entire amount, only to the extent of accumulated profit, which in my example is how much? 40. So 40 went to the IFOS, then balance 60 of the consideration amount will be treated as full value of consideration, and accordingly the capital gains will be computed. Now, in computing the capital gains, I will also require the cost. What is the cost? Cost of the shares is what I'm going to reduce, and the balance is what will be referred as what, students? Exactly, students. It will be referred, students, as the capital gains. Very good. Keep revising, students. These things, they are very important particular sections. And if from an examination point of view also, if I have to tell these section, students, you will definitely will find, or you will have a particular relevance in the examination as well. Now, students, let's come to the another particular important structuring. Students, the next business restructuring is not on the particular side of the share capital. The business restructuring is now at the side of the entity level. Now, up till now, we were looking from the capital reduction, we were looking for the buyback, we were looking for the preference shares redemption. I give you a lot of example. So those restructuring was done at the capital level. Now I'm talking about the restructuring at the entity level. Students, can you copy one important particular chart which I'm preparing for all of you? Please do copy down this particular part. I want all of you to copy down this in your notes. Students, please copy down this. Business restructuring. So at the capital level, capital level means buyback of equity shares. So this is, students, covered in which charting section? 69. Then there is, students, redemption Redemption of preference shares. Is redemption of preference shares, first of all, please tell me, is preference share a capital asset? Yes. Is redemption will result into extinguishment of the right of the preference shareholder? Again, the answer is yes. So redemption of preference share, students, it will be a transfer in the form of extinguishment of right in the company, and therefore it will be considered as a transfer of a capital asset, and on that chargeability will be attracted under section 67(1), general charge. Also, students, reduction reduction of share capital, students. Reduction of share capital. Now, so far as reduction of share capital is also concerned, students, the chargeability will be under section 67(1), isn't it? The chargeability, students, is also under section 67(1). Now, here for the buyback particular part, students, the special point that we all have discussed was about, in this particular context, the special point was about the additional tax that we have referred. Additional tax, students. This is a special point. That is what we have referred in this context, isn't it? So this is precisely what you should always bear it in mind. So first is the business restructuring at the capital level. And now here the second particular point, students, which I have to tell you is about the business restructuring, which is at the entity level, students. At the entity level, students, in this context. So this is about the business restructuring at the entity level, students. Please copy down this one. Fine. Now, students, at the entity level, there are various cases, like for example, slum sale. That business restructuring can take place. There can be business restructuring in the form of an amalgamation, or for that matter, demerger, or for that matter, conversion. We'll see these things, students, conversion or succession in this regard. Conversion or succession. I will take you through, students, to the first three primarily, and once this three you will know, the conversion succession, students, you will know exactly what it is. It's very easy. These are the entity level, students, business reorganization or business restructuring that is taking place. Business reorganization or business restructuring that is taking place, and therefore, students, even in this particular case, there are capital gains implication. There are capital gains implication. Okay, I start today, students, at the very start. I'm starting with slum sale, one of the most important particular business reorganization or business restructuring. Even from the examination point of view, students, it's very important. And independent questions are targeted in the exam. So I have kept a comprehensive question, students, on slum sale till the tax liability, how to calculate tax liability. So you will run through everything till the tax liability on the slum sale part. But before that, students, I start off. Can anyone tell me, either of you students, what do you mean by the term slum sale? What do you mean by, students, by the term slum sale? Quickly, students. What do you mean by the term slum sale? Whatever, students, whatever you may think of it, doesn't matter. Just make a try. What do you mean by the term slum sale? Exactly. Very good. Very good, students. Slum sale, students. Slum sale would mean that I am disposing of my undertaking. I am disposing of my undertaking without assigning what? Without assigning any values to the individual assets and liabilities. Without without assigning to the without assigning any value to the individual assets and liability of that undertaking. So if an undertaking is transferred to another person without assigning the value to the individual assets and the liabilities, then such transfer is said to be on account of slum sale. Very good, students. Is said to be on account of slum sale. Have you heard this word, students? It's just like selling off. Selling off, students. Selling off what? Selling off lock, stock, barrel. Lock, stock, barrel means as it is, where it is basis, sell it off. No valuation to be done. Lock, stock, barrel. Isn't it? Lock, stock, barrel means as it is, where it is, sell it off. Don't value. This is the key. Take it. Tell me the price. This is the entity. This is the undertaking. Primary. Price, I accept it. Now this is your company. So without assigning the values to the individual assets and liability, such transfer of the undertaking is known as slum sale. Students, in fact, if you just see before we enter into a tax particular part of the provision, you should just first visualize. There is also a case of an demerger. In demerger, what happens also, students? In demerger also, say there is a company like, say for example, Tata Sons. Tata Sons as a company. Now, one of the undertaking of Tata Sons, say for example, TCS or Tata Motors, they want to create an independent entity. They want to give them an independent management. So they try to transfer this undertaking to a new entity. Say, for example, the new entity is Tata Chemicals, Tata Motors, TCS. These becomes a new entity, which were earlier a part of Tata Sons. Isn't it? But then what happens in the case of demerger, students, as compared to slum sale also, an undertaking is disposed of and a new entity takes over this undertaking. The fundamental difference, one of the main difference, there are other differences also, but just one of the main, is that in the case of a slum sale, you are not assigning any values to the individual assets and liability, just a lump sum price. I'm just talking from a layman point of view, students, right now, so that you grasp this particular thing. Now you will say, sir, why people do it? There are many reasons, students, the people do it. You can say the business realities and all. And that is precisely what this particular slum sales comes under this category. So one, you should understand very carefully that you should first also appreciate a definition. What do you mean by slum sale? So if you find that the question may not be very specific, you may not be told that this is a question of a slum sale, but they would tell you that the undertaking was being transferred without assigning any values to the individual assets and liabilities. This sentence is what they will tell you, and from that you need to now know that the question that they target, students, is that of a slum sale. Now, students, don't you think that this slum sale by itself is a very unique now? because the entire undertaking. Now, what is can anyone tell me, students? Now tell me. I want to know that what has been transferred. What has been transferred is the undertaking. Can anyone tell me what is the capital asset which is involved? What is the capital asset which is involved on which there is a transfer that has taken place? What is the capital asset which is involved on which the transfer is said to have taken place? Tell me, students, what is that capital asset which is involved in this concept of slum sale? What is the capital asset which is involved on which the transfer has taken place? Quickly answer this one. Proposition. Every one of you. So, students, indeed, it is the business undertaking. Very good, students. Excellent. It is the business undertaking. The capital asset here, don't say plant and machinery. Don't say any other assets. The larger right is that of the entity itself. The entity is what has been transferred. Students, do you remember one thing? In your inter CA, you people would have referred goodwill of a business, goodwill of a profession is considered as nil value. Heard of it? So here the asset is the goodwill, isn't it? But please understand, if the business itself has been transferred, so the right is a larger right on the entire undertaking and not restricted right on a particular asset. Are you getting the difference? The right is on now on the entire undertaking and not restricted to on a particular asset. And therefore, the capital asset, what is the definition of capital asset? A right. So the right now is on what? On the undertaking and not restricted to a particular asset. And therefore, the capital asset which is transferred in a slum sale, the capital asset which is transferred in the slum sale is the business undertaking. In that case, isn't it? But students, tell me now one thing. If, be careful of what I'm saying, this is the uniqueness of slum sale. Students, just tell me one thing. If I assign the value to the asset, that look, your plant and machinery would be, valuation is done at 5 crores. This valuation is done at say 6 crores. The other asset, say for example, land and building, valuation is done at 15 crores. Now you tell me what is getting transferred is the undertaking or it is the assets of the undertaking which is getting transferred along with the undertaking. It is the assets of the undertaking, students. Why? Because you are assigning the values now for each assets which are being taken over in the process of the takeover mechanism. So the moment you assign the value to the asset, the moment you assign what? The value to the asset, this will become, students, what? The moment you will assign the value to the asset, it will be considered as a sale of sale of the assets and not the sale of the undertaking. But in the case of slum sale, do you assign any value to the individual assets and the liabilities? No. So the value, if at all is assigned to the undertaking as a whole. And if that is the case, students, if that is the case, then we say that the capital asset which is transferred is the undertaking, and the undertaking which is the larger right and not restricted to a particular asset of the undertaking and not restricted to a particular asset of the undertaking. Is that point clear to all of you students? Please tell me. Radha is asking, if only few assets are assigned value, then it is an asset sale. It is an asset sale. As far as slum sale is concerned, no value has to be assigned on any individual assets and liabilities. But if supposedly you are just cherry picking three assets, so it will become a case of an asset sale. I hope that all of you are clear with this one. If the concept is clear, then can we now come to our next step, which is the computation mechanism. The chargeability ingredients. What is the capital asset? What is a transfer? Those ingredients are clear. We now move to the next one, students, and that is a computation part. Obviously, students, this is a case of, obviously, students, this is a case of, students, this is a case of what? This, students, is a case of a business undertaking being a capital asset which is transferred. A business undertaking being a capital asset which is transferred. Do you all agree? Perfect. If the business undertaking being the if the business undertaking has been transferred, students, then my next question to all of you is also ready. In this case, the capital gains computation, students, would be very unique over here. What is the capital gains computation? The capital gains computation, yes, remain the same. Full value of consideration, less expenses of transfer. That will give you the net sale consideration. Net sale consideration. And from net sale consideration, students, you are going to reduce the cost of acquisition. And the cost of acquisition, students, in that particular case, reduce the cost of acquisition, you will get what? You will get the capital gains. You will get the capital gains. Okay. Now the question is, we don't restrict ourselves, students, we don't restrict ourselves on the capital gain. We have to first determine the character of the capital asset whose transfer is involved. So here the capital asset is the business undertaking which has been transferred. So first we need to assign whether the business undertaking, which is a capital asset, whether it is a long-term capital asset or a short-term capital asset. The business undertaking, which is a capital asset, whether it is a long-term capital asset or a short-term capital asset, is the first question that we need to decide in this case, isn't it? And accordingly, the nature of gain will be characterized thereafter. Accordingly, the nature of gain would be characterized. So first, characterize the nature of capital asset. The capital asset is a business undertaking. Now, be careful, students. We know, just be very careful what I'm saying. We know that to determine the nature of capital asset as a long term or short term, we check the period of holding. Up till now, students, the period of holding that you people have learned is of 12 months and 24 months. Can you just type it, students? 12-month period of holding is for which class of asset? Please type it just now. Let me see how many of you have revised it. The 12 months period of holding is applicable to which class of asset? Quickly, students. Rather, they are 12 months. It is indeed, Kanaya, the listed securities, units of UTI, zero coupon bond, listed security, units of UTI, zero coupon bond, and for all the remaining asset, it is 24 months. For all the other asset, students, it is 24 months. So what about the unlisted shares? Unlisted security. For those unlisted share, the period of holding to be considered, whether it is long term or short term, would be 24 months. So if it is more than 24 months, it is long term, less than 24 months or up to 24 months, it is short term. But so far as, now be careful, there is a third category also, which is 36 months. And that 36 months, students, is applicable only in the case of a slum sale. Only in the case of a slum sale. Now, the capital asset, students, what is the capital asset? The capital asset is the business undertaking. The capital asset being the business undertaking, if it is more than 3 years old, students, if the capital asset being the business undertaking, if that is more than 3 years old, it will be considered as a long-term capital asset. if the capital asset, being the business undertaking, is up to 3 years old, then in that case, it will be considered as a short-term capital asset. A short-term capital asset. Computation, students, will remain the same. Full value of consideration, less expenses of transfer, net sale consideration, cost of acquisition. And then thereafter, the capital gains. That's it. By the way, students, are you aware now? I think many of you in inter CA, you people have not done. Any case, it is going to come now in final CA also. The indexation concept is gone, except in one particular case. Are you aware of that, students? Just let me know. The indexation concept probably is gone except in one particular case. Which is that case also we will see. But are you aware of this or not? Because some of you may be wondering, sir, long-term capital gains we are computing, but what about the indexation benefit? Isn't it? So students, let me tell you one thing now. Now the concept of indexation is no longer in existence. Even if it is a long-term capital asset on which you calculate a long-term capital gains. However, there is an exception to this rule. What is that exception? That we will see. That time has not yet come. But now as a thumb rule, students, I'm just telling you on this part. Thumb rule, students. The concept of indexation is gone. In this case, even if it is a long-term capital asset on which you are going to calculate the long-term capital gains, the indexation will not be applicable. The indexation, students, will not apply in this case. And that is the reason why, students, please tell me, long-term capital gains other than 198. Long-term capital gains other than 198 is taxable under section 197. The long-term capital gains other than section 198 is taxable under section 197. And what is the rate of tax of that long-term capital gains? What is the rate of tax of that long-term capital gains? 12.5%. All of you agree? 12.5%, students. In this case, exactly, students, 12.5%. So 12.5%, students, is the rate in D, students. 12.5% is the rate. So if it is 12.5%, so if you remember in inter-CA or maybe any earlier point of time, students, you would have known that earlier the LTCG rate was at 20%. But now we say the LTCG rate is at 12.5. Why? No indexation. So as a general rule, students, now just keep in mind that in computing the LTCG, you will not be giving the effect of indexation. However, there is an exception that will come in the subsequent class. There is an exception to this one. Now coming on the slum sale particular part, students, now quickly on the slum sale issue, students, let's have a look. So chargeability is over, capital asset, business undertaking which is transferred. That capital asset, whether it is long term or short term, how do we know? We know that if the business undertaking is more than 36 months old, if the business undertaking is more than 36 months old, then that undertaking will become long term or else it is a short term. Isn't it? How do we do the computation of slum sale, computation of capital gains on account of slum sale? Normal computation, full value of consideration, less expenses of transfer, net sale consideration, then reduce with the cost of acquisition, and finally what? The capital gains. However, now students, the complication arises. Here lies the thing. Now what they have done, students, is this. Be careful, students, now. All of you. Students, just a second. So students, over here, The full value of consideration that we have told. This full value of consideration runs. They've said that it will be higher of the two amounts. So each element, full value of consideration and the cost of acquisition, each element they have sought to define it. So it is not only restricted to amount received on account of slum sale. No. What they have instead done is that they've said that the full value of consideration over here is the higher of the two amount, and higher of the two amount is the fair market value 1 will be compared with the fair market value 2. So higher of the two amount is your full value of consideration. Now what is this FMB1 and FMB2 that we will see, but just the format over here in this case. So therefore, the full value of consideration will be higher of the two, FMB1 and FMB2. Now, apart from that, expenses of transfer, if any, would be on actuals. Then the next that you reduce, students, is the cost of acquisition. Now, the cost of acquisition of the undertaking, students, is what? Is the net worth. Is the net worth. Is the net worth. Fine, students? Because it is the undertaking that you have transferred, isn't it? What you have transferred, students? What have you transferred? You have transferred, students, the undertaking. And the fact that you have transferred the undertaking, accordingly, the cost of acquisition is the net worth which has to be reduced. The cost of acquisition, students, is the net worth that you have to reduce. I hope that all of you are clear with this one. Every one of you. So this is what would be reduced. Now, students, I'll tell you a bit of logic behind this. The government, when they made this particular amendment, otherwise, see, generally what happens is that people just try to remember it, but difficult to remember. If we can understand it, it's good. Like the way I've taught you through the buyback, how to remember the rates and what is the objective. The government wants it to touch to the base rate. Similarly, here also, students, if you will see this valuation provision very closely, let me in fact first take you through to this valuation provision and then I'll tell you the logic. Otherwise, you will not be in a position to appreciate it. Let me first take you through the valuation. What exactly is the FMB1 and FMB2? And then I will tell you the logic behind this. I think that time you will appreciate the fundamental nuances that is applicable over here. Let's try to decode through this FMB1 and FMB2. So students, over here, if you see slum sale, capital gains, this is a higher of, which you can see, FMB1 and FMB2, and minus to that is the net worth. Now, therefore, the question is, in this case, the FMB1 and FMB2, let's try to decode that first and then I'll come to the net worth part. Let's have a look at FMB1 in this regard. So, FMB1, friends, rule number 53 of the income tax rules 2026. What it says over here, students, rule number 53. A plus B plus C plus D minus L. First of all, many of you would see, sir, but what is FMB1? FMB1 is nothing but the capital asset. What is the capital asset that you have transferred? The capital asset that you have transferred is undertaking, isn't it? So whatever is the value of the undertaking, family. So the valuation of the undertaking that you have transferred, that becomes the FMB1. The value of the undertaking that you have transferred, that becomes your FMB1. Then what is the FMB2? The amount that you have received, on transfer of that undertaking, that becomes your FMB2. Repeat with me, students. What is FMB1 and FMB2? FMB1 is the value of the undertaking that you have transferred on account of slum sale. That is your FMB1. And what is your FMB2? the amount or the value that you have received as a consideration is your FMB2. So this is what is, and the higher of the higher of the two is your full value of consideration. So let's look upon the first one, which is the FMB1. The first one is what? FMB1. Now, if you see over here for the FMB1, what is that? The value of the undertaking, which is the capital asset, the value of the undertaking that you have transferred. They say it is A plus B plus C plus D minus L. Now, every one of you would have known by now, A plus B plus C plus D is the value of the assets, and minus L is the value of the liability. So L, students, I'm discarding it first. Simply put, students, book value of the liability as appearing in the books. In a simple word, students, I'll just write in this case, just to make you understand very quickly, this is what book value of the outside liabilities. Book value of the outside liabilities. That becomes your L. Now, what is A plus B plus C plus D? Now, see, students, over here. This is A is book value of all asset, but except what? Except the two categories. Students, except the two categories. Which are the two categories? Except the two categories. The two categories are from jewelry, this thing, to security. And the second category, students, immovable property. From jewelry, artistic work, shares and security. Oh, sorry. Just a second. Just a second. Excuse, please. This is one. Shares and security is 2. And this is 3. Immovable property is 3. So book value of all the asset other than jewelry, artistic work, drawing, etc. That category. So other than that, and other than what other two things? Immovable property also. And what about the other thing, which is shares and security? Now, students, one caution to all of you in your examination, students, please respect this particular the sequence that they've used. A plus B plus C minus L. This is a statutory formula that they've given. And A denotes this. So it is not that this is a outside the statute that this A plus B plus C minus L is determined. So when you write in your examination also, if the question comes, please maintain this consistency, because these are statutory formulation. It is not my formulation that I'm giving it to you as an equation. So therefore, A is the book value of all assets, other than which, students? Other than 3 assets. Which are the 3 assets? One is the jewelry and the artistic work. Second one is the shares and the security. And the third one is the immovable property. Then by default, please tell me, students, what is B? B would be jewelry and artistic work. What is C? C is the shares and security. And what is D? D is the immovable property. Very good. So A plus B plus C plus D minus L. I hope that all of you are clear with this one. Now, therefore, the question is, sir, we have taken book value of all the assets other than these 3. What about these 3? Are we going to take the book value of these 3 assets also? Answer is no. Otherwise, if we have to take book value, why we have to remove them from A? Isn't it? So their value, students, is more like a fair market value. So it's not a book value. So a crux of these 3 assets, students, please understand, the government does not want to tax or does not, this full value of consideration. We are determining the full value of consideration on which the capital gains will be computed. All of you will agree with me, students. All of you will agree with me. Higher the full value of consideration, higher the capital gains. Do you all agree? Higher the full value of consideration, higher the capital gains. You will also agree with me, lower the cost of acquisition, higher the capital gains. Lower the cost of acquisition, higher the capital gains. Please keep this point in mind. So the attempt, if the government wants to increase the liability or want to increase the tax collection, then what do you think? Will restrict the B plus C plus D on the book value? B plus C plus D on the book value? Answer is no. They would definitely would want that these jewelry should go on the fair market value basis. Just imagine the jewelry and all those things. If the undertaking has the fair market value as compared to the historical value, what could be the valuation that we are expecting? It's a huge one, students. So B is about this. So amount of jewelry as it will fetch in the open market on the basis of the valuation report. C is what? The fair market value of the shares and securities as determined in Rule 57 later on, students. But just keep in mind fair market value of shares and securities. And D for immovable property, students. I I will expect that you know for immovable property, students, we take always the safer valuation code. For immovable property, we always take a safer valuation code, which is a stamp duty value. Which is what? The stamp duty value. Do you all agree? So therefore, whenever it comes to immovable property, it is a stamp duty value. When it comes to jewelry or the shares and security, it generally is a fair market value. Okay. Fine, students. So therefore, this will become my A plus B plus C plus D, and then minus L, book value of all outside liability. Now this is my FMB1, students. What it is? FMB1. What is FMB1? The value of the capital asset which is transferred. What you have transferred? What is the capital asset that you have transferred? The capital asset is the business undertaking which has been transferred. Now students, in that business undertaking, I have to see the balance sheet. So I will see the balance sheet of the business undertaking. Now, the balance sheet of the business undertaking, the whatever is the book value of the asset, except for the three category, I will take the book value of all the balance asset, except for the three category. And for the three category, starting up with, say, jewelry or shares and security, it is the fair market value is what we take. And the last category, which is the immovable property, it is a stamp duty valuation that we will take. So this is my A plus B plus C plus D of this undertaking, which I have transferred. And then from this, you will reduce the L, which is of this undertaking, which you have transferred. What is the outside liability that you are going to reduce? This will give you FMB1 of this undertaking. Now tell me, this FMB1 has to be compared with FMB2. And the higher of FMB1 and FMB2 is the FVC, full value of consideration. So what is this FMB2, students? What is this FMB2? Quickly, students. What is this FMB2? FMB2, I told you already, the value of the consideration I received. So when I transfer the capital asset, I would have received something. So therefore, what I have received, that value is my FMB2. Now that what I have received, students, can be in money, and also it can be a non-monetary consideration. What I have received, students, can be in money. Also, it can be in non-monetary consideration. Do you all agree? Yes. So if it is what I have received, if it is in money, there is absolutely no problem. But what if I have received is a non-monetary consideration, students? What I have received, students, is a non-monetary consideration, students. In that particular case, students, it is what? It is the, again, the same problem will arise. Again, the same problem will arise. So, therefore, what they say, if what I have received, point number E, students, please have a look over here, all of you. What I have received, if it is in money, have a look, students. Value of the money. But then E plus G plus H is if what I have received is non-monetary. For example, the first one, students, here the same thing. Tell me what will be F, G and H. Derive yourself. You would have known by now, students. Read this F, G and H and please tell me what this F, G and H will be. All of you should. Quickly, I'll give you a minute time. What will be this F, G and H? Students. Indeed. Radha, Karaya, Lakshmi. So students, indeed that particular case. So over here, students, in that context, as far as H is concerned, you would have known what it is, immovable property in this context. So far as G is concerned, students, so far as G is concerned, what it will be. Say for example, students, I may have received plant and machinery. I'm just giving you students over here. In this context, you would have known by now the fair market value students has been used for this. F is using the word fair market value students in this regard. Now, I have told you, so this fair market value over here is in respect of the shares and securities, or for that matter, the jewelry and all, in this regard. So, therefore, this is what point number F is in this context. Okay, F in this context is shares and security, jewelries. These are some of the items. But say, for example, students, I have sold my undertaking. I have sold my undertaking. And against the undertaking, I am receiving, say, 10 crores of cash and I am receiving a big plant and machinery. Plant and machinery, students, I have received. Now, I have received a plant and machinery in this case. Is this a non-monetary consideration? Yes. Is it an immovable property? No. So, it has to be between F and G. F talk about fair market value of the non-monetary consideration received, and that is in table number. Can you see this rule 57 table number serial 1 to 5? This is nothing but students, shares and securities and jewelry, artistic work and other items. This is what has been covered over here. So therefore this, for example, plant and machinery, that is what I have received. See, I may have received some stocks in this case. So that plant and machinery and other things, what I have received will go under G. So G students covers what students? You can just write if you want. In this case, in the case of students, E or E already you know. So just write F and G. F is what covers in F? FMB of shares and securities. FMB of shares and security, jewelry, artistic work, etc. This is F. FMB of jewelry, artistic work, shares and securities. This is F. G students is, what is G? The open market value of all the other movable asset. Of all the other movable asset received as a consideration. Received as a consideration. Please underline the word received as a consideration. On account of slum sale. On account of slum sale. Fine, students. Now, FMB1 and FMB2 we have decoded. Students, FMB1 and FMB2 we have decoded. You have to take higher of the two This higher of the two will become what, students? The FVC. Again, I'm repeating, students, FMB1 is the value of the undertaking which I have transferred. So it is what I have transferred, its value. What is FMB2? What I have received, its value. So transfer value versus receipt value. What I have transferred, we have transferred the undertaking. If you have transferred the undertaking, what is its value? A plus B plus C plus D minus L. Minus L. Okay. L, book value of outside liability. A is the book value of all asset minus three categories. Which are the three categories? One is the jewelries. Second is the shares and securities. Third is the immovable property. For jewelry, students, in this case, it is again, all these are fair market value or the open market value. If it is in the balance sheet. Whose balance sheet? Undertaking's balance sheet. Similarly, if the undertaking's balance sheet has shares and securities also, then again the fair market value of the shares and securities. If the undertaking balance sheet has some immovable property like land and building, factory building, land, then that particular again would be on the stability valuation. That will be on the stability valuation. So that is your A plus B plus C plus D of the undertaking minus the L, which is the outside liability. Reduce it, you get FMB1, which is the value of the undertaking that you have transferred. FMB2 is what you have received of its value. What you have received as a consideration, the value of the consideration that you have received is your FMB number 2. This you will compare and that will give you the full value of consideration. Now you have to reduce. Reduce with what? With the net worth of the undertaking. With the net worth of the undertaking, students. Now the question is, sir, net worth of the undertaking. What is net worth, students? Again, the net worth is asset minus liability. Asset minus liability. The net asset approach. So net worth would be asset minus liability. So the cost of the undertaking, which is transferred in slump sale, that cost of the undertaking is its net worth. And what is net worth? Asset minus liability. Now you will say, sir, but just now we did asset minus liability for FMV1. That is the value of the undertaking transfer. Again for net worth I am doing. Again the net worth I am doing asset minus liability. Same thing. No, students, it is not the same thing. Now, I will not answer this. I would want you to apply your mind and try to get your answer. Let me see. Probably, can you pick this one up? Because this is where the students confuse towards the end, students. This is the maximum confusion that arises. And you need to crack this code over here, students, now. And you should appreciate the logic. In fact, I already gave you the hint of that in this case. I already have given you enough hint of that. So, students, what I want right now is you will read the net worth in this context. And once you have read the net worth, now you tell me what is the difference that you are picking up of net worth versus FMB1. I need to know the difference, students. Quickly, start reading for students. So this is the first two limbs, and then I'll take you to the next two also. Students, appreciate the logic. Don't only by heart. Because once you appreciate the logic, it will stay with you for a longer period of time. So depreciable asset, it is the WDV. Self-generated goodwill, not acquired or purchased from the previous owner, it is nil. Okay. And what about the other? See, students, over here. See other items. Quickly run through it, students. And I would want the answer from one of you. Students, are you all through with this one? Every one of you. Can you tell me now the logic? If it is possible.
Yes, sir.
Yes. Please say, Anna.
Sir, logic, what I got is because specifically income tax is following specific rules. For example, WDV in case of depreciable assets. And under Section 46, it is already, we know that we are getting a whole 100% deduction under Section 46, the specific assets. So, and remaining other assets, it's taking book value. So, irrespective of other assets, irrespective of the categorization of immovable property or movable property, as far as my knowledge, and yes, and revaluation is automatically ignored. So, henceforth, when we are calculating FMV 1 and 2, so revaluation effect is already taken into effect as per the market value.
For
And
FMV1 and
liabilities is,
FMV2.
yes, sir.
Yeah.
So,
For
that
net
is
worth? For net
all.
worth? Net worth, Anna?
Yes, sir. So ultimately, the asset's value is being derived by the book value or being the WDV of the specific asset, and that is what is being taken into consideration. And the net worth is the difference between that asset and liability.
Yes. Very true. Very good. So, students, Kanaya, your answer is also correct. I'm reading your answer also. You have picked it up, students, now. Students, you would have realized now FMB1 is also actually a net worth. But the net worth was on the market linked. Whereas if you see the net worth for the cost of acquisition, what you are going to get? Net worth for the cost of acquisition. Here, it is a very conservative approach. It is measuring the book value or the WDV. Supposingly, students, the undertaking has got a jewelry. Just imagine this. I'll just tell you the visual. I just want to give you a visualization. How it will happen. I'll give you my numbers first and then we do the question, students. Okay. Let me give you my number first on this context and then you can appreciate what these people have played the game in this context and what they are trying to get into it. But I told you, students, higher the full value of consideration. Remember this always, students. Capital gain, if you appreciate this chapter as a whole. Higher the full value of consideration, higher is the capital gains. Lower is the cost of acquisition. Lower the cost of acquisition, again higher the capital gains. So, so students, just have a look. Just have a look. What they have done. Supposing this is a this is the entity B limited. Okay. I give 3 value over here. Let me give a 3 value. So this is liability, assets. Now for asset students, let me give a 3 valuation in this context. So assets students, book value, WDV, WDV, and say FMB or SDV, I'll write. FMB or SDV as one category. Fine, students. You will also copy down to this one because you will should be in a position to visualize the balance sheet. This is the balance sheet. This is the undertaking. So this is the undertaking. Just a second. This is the undertaking. Transferred in slum sale, SS, slum sale. Transferred in slum sale. Okay. Now let's have a look to one by one. One by one, students. Land, book value is 100. WDV not applicable. Stamp duty value is 250. Okay. Building, book value students is 50. WDV is 30. Stamp duty value of building is 70. Stock, book value is say 20. WDV students is say there is no WDV. Fair market value in this context. Here it is say 30. This is for stock. Right? Shares, book value 100. No WDV. FMB say 130. Thereafter students, jewelry, book value 100. No WDV. Say 200. WDV means WDV for income tax purpose. This WDV would be WDV for income tax purpose. And finally, students, there is an outside liability of 300. How much is the outside liability, students? 300. Okay. One more information I'm just giving you, students. In this case, one more information. Lump sum consideration received is rupees. Lump sum consideration, students, received is rupees 600. Now, students, I want from all of you. So the question that I'm asking herein, question is FMB1. What is FMB2? What is net worth? And what is capital gains? Four things I'm asking students. FMB1, FMB2, net worth and capital gains. Four things. You do it properly, students, you'll know the difference. FMB1, FMB2, net worth and capital gains. Assume, students, it is a more than 36 months old undertaking. Assume it is more than 36 months old undertaking. So on that basis, students, tell me what is the FMB1, FMB2, net worth and capital gains. Quickly, students, I give you only 2 minutes time. Should be easy. Quickly, students. And then after that, we'll solve one more problem. So that, students, your concept becomes crystal clear on this particular area of slum sale before we move to the next segment. So let's start, students. FMB1 is the FFB1 is what? Value of capital asset transferred. Value of capital asset transferred. And what is that, students? A plus B. A plus B plus C plus D minus L. This is what exactly it is. This is my FFB1. A plus B plus C plus D minus L. Okay. What is A, students, over here? Book value of all the asset except three. Which are the three? Which are the three? Jewelry and other assets. Jewelry, artistic work, shares and securities, and immovable property. So other than that, what is left in this question? Stock is left. So tell me, students, now for the stock therefore is A. Tell me for A here, the A which is there, students, what is the amount? A as this, what is the amount? Students, indeed, it will be 20 only. Only 20 students. The fair. Oh, students, this electricity has gone, just unfortunately, but just tell me. Oh, okay, it has come. Something you would have tripped. Anyways, students, over here now, this I think some tripping would have happened. Don't know what it is. So A it is. So A, students, it is 20 in this context. A it is 20. Fine. You will take only the stock. You will take only the stock book value. There are other assets are B plus C plus D. Now what is B? Students, B would be the jewelry and artistic work. For the jewelry, what are you going to take? 100 or 200? It has to be 200. What about C? C would be the stock and shares and securities. Again, whether you will take book value or you will take FFB, you will take FFB 130. What about the D, which is the immovable property? Immovable property, what is the value that you are going to take? It is land and building. Again, the stamp duty value. Stamp duty value is how much? 250 plus 70. It is 320. So therefore, this is what it is. So A plus B plus C plus D, students. How much is the amount? The amount, students, it is 670. If I'm not wrong, so just confirm. 670. That is A plus B plus C plus D minus L. So don't forget, minus L. Minus L. Outside liability 300. So this will give you 370 is my FFB1. 370 is my FFB1. What is my FFB2, students? Already given lump sum consideration received 600. So therefore, what is my FVC? My FVC, therefore, students, is 600. My FVC, students, would be 600. Now, students, I want you to compute net worth. E plus F plus G. Students, in this case. So here, if you see, for the net worth particular part, what are the assets that we are taking up, students? In this case, very conservative approach. Now, if you see for the net worth, whatever are the depreciable assets, students, as you all have said it, sorry, net worth, not E plus, so that is FMB2. Just forget that I spoke just now. E plus F plus G, that is FMB2. But right now we are talking about net worth. FMB2 already it is given, and I assume that this is a monetary consideration, so it is E. So this FMB2 is E over here, and E is how much? 600. Now comes the net worth. Net worth is the most conservative approach. First, they will take up the depreciable value as per the income tax law. And if you can see, wherever they can reduce it, as much as they can reduce the cost, which is the net worth. They are trying to reduce it. See here, building students. WDV is what they take. So depreciable asset, year in, WDV, so 30, depreciable asset. For all the remaining asset students, all the remaining asset, they will take again only what? See what they are doing. For all the remaining asset, 100 plus 20 plus 100 plus 110, 100. So this much, this comes to how much? 320 students. 320. 30 I have taken of building students. Now land is 100, stock is 20, shares 100, jewelry 100. So it is 320. So this is net worth. Now from this, which is 350. So 350. So this gives me 350. From this, I will reduce the outside liability. Outside liability is 300. So Shruti, can you see? My net worth is only 50. Compare this with FMB1. FMB1, it was 370. Whereas now, can you see this? My net worth should have same approach, asset minus liability. But what value of asset you are taking? WDV as the value. Book and for remaining asset, book value. As much as conservative approach that you can adopt is what is getting adopted for net worth. This is the philosophy. So full value of consideration minus the cost, which is the net worth, will fetch you the capital gains. Will fetch you the capital gains. I hope that all of you are clear with this one. Now just see over here, 50 is only my net worth. So from here, if I reduce the cost, which is net worth, how much it is? 50. So finally, my capital gain students, how much it is? Long-term capital gain it is? Indeed, the LTC students, it is 550. The LTCG students, it is 550, and that exactly is the point. That exactly the point. I hope that all of you are clear with this one. Every one of you. Now, if that is the case, there is one more question which is there. I could give you as a homework also, but I think you would have picked up the concept now. You want to do as a homework or let's do it now? Radha, Kanaya. For self
So we can do it. We can do it easily.
easy. So I think now you have understood the concept. You have understood the crux of the things. Now, please ensure to do it tonight and try to solve it on your own. The main catch of this entire slump sale is what? The main catch of entire slump sale is to understand, compare FMB1 versus net worth. And you will know the philosophy. The FMB1 is also the net worth only actually of the undertaking that you have transferred. Cost is also the net worth. But see the approach. Because FMB1 is associated with the full value of consideration. What is the attempt that the government is making, students? What is the attempt that the government is making? The attempt that the government is making is to try to increase as much as possible the FMB1. And that is also the attempt we have found in FMB2 also, students. In FMB2, if it is a consideration is non-monetary, then the government says, thank you very much. If it is non-monetary, what is non-monetary? Is it immovable property? Then SDV, stamp duty value. Is it shared securities, jewelry in a fair market value? If it is like a plant and machineries or any other assets, it is the open market value. So again in FMB2, there is an attempt which we find that the government wants to increase as much as possible the full value of consideration. And in the cost, which is the net worth, an attempt which has been found, an attempt students is found to reduce as much as cost as possible. And for which what is they have done? Students, what they have done? They have used cost for cost purpose. You are using WDV. You are using the book value for the remaining assets. Book value for the remaining assets. And that exactly is the point. Now, if you can appreciate this, students, you have literally won the entire game.
So
Perfect.
yes, like FMV1 and FMV2. So why would the company would be selling below the fair market value? Actually, that was I was thinking that
Now, understood this
income
particular part?
tax. Yeah, no, so yes, sir, I understood. But then I was thinking that see here always the FMV2 would be having the upper hand, as compared to FMV1? Because why the particular entity would sell below the fair market value? That's what I was thinking.
Why the no slum sale? If you see one thing, we should actually then check out the larger particular question. And what is the larger question over here? The larger question is that why we should, in fact, why there would be a slum sale then? That will happen without assigning the values to the individual assets and individual liabilities, isn't it? Now that there could be n number of reasons, family, for which the slum sales can take place. So there could be a case when the undertaking which is there is not that healthy undertaking. There can be a case when the undertaking is really very promising undertaking. Like for example, I'll tell you one example I can give it to you. There is a case of one example which I know practically because I have done that. One slum sale. It was like a hostile takeover kind of a scenario. There were a company students in which the creditor have exceeded the equity actually. If you see the liability side. So the creditor exceeded the equity. So obviously they have a dominant position now as compared to the shareholders, as compared to the owners per se. The company could not pay off their creditors. So what the final deal happened was that the creditor will make they will take this. The creditor was actually also a company, by the way. This creditor said that there is your one of the undertaking to whom we are supplying the materials. We want to take over that particular undertaking as a settlement, and we will give you a top up lump sum amount. That's it. No question asked. So there was no fair valuation that was being done in that process. So therefore, in that situation, this undertaking was being taken over and handed over to the creditor, which was also a company, which was actually a supplier. Now, was there any valuation process that happened? No. As a matter of a goodwill, the creditor gave you. This is say 50 crores more. I'm just giving as it is. And because obviously creditor being a supplier, they were aware of the business reality, the synergy that this undertaking can give it to me. So that is it. They said that this is 50 crores. Now, whether that value 50 crores was a throwaway price or a price which is at a premium, we don't know. Probably in that case, this is what the slum sales are. Sometimes what happens is that the undertaking itself is very regressive, very poor performing. Now, if it is a very poor performing undertaking, the whole value this undertaking. In fact, sometimes what happens, the cost of valuing this undertaking would be higher than the undertaking itself if somebody starts valuing the undertaking. So, who will do the valuation exercise? And if that is the case, this undertaking is transferred lock, stock, barrel at a particular amount. That is also a case of a slum sale. So there can be n number of reasons why the slum sale could happen. You cannot have a particular pinch that, okay, this is why the slum sales are happening. There cannot be this could be the reason why the slum sales are happening. Did you got this one? This is I'm telling you the business realities.
Yes, sir. Perfectly clear.
Perfect. Now I'll tell you one important point here. So that question which I am giving you for a homework, which now I am very much aware that you people will do a capital gain, but there I have put a twist. Students, I told you that I will be our question, students, when we do it, we will be doing an integrated approach. Did it? I told you. In fact, students, one PGBP question 35 AD. I am attempting not today. We will try to complete that also so that nothing is left. Students, tell me one thing. In the last lecture, to just okay, I will not give you the hint. If I give you the hint, then the thrill would be lost, isn't it? So let me not give you any hint at all. Student, this is a question. I don't want you to calculate anything. Calculation would you do at home as a homework. But there's a beauty in this particular question. And then you'll appreciate the approach that we have adopted. Students, here, PQR Limited has two units, hardware unit and software unit. Now, students, as a part of restructuring, it sells. As a part of restructuring, it sells the software unit as a going concern by slump sale on 31st of March 2027 for monetary consideration of 385 lakhs. Now, here the question itself said to you it is a slump sale, so you don't have to worry. Lump sum monetary consideration has been given to you. This will be your FMB2, isn't it? But if they will not tell you that it is a slump sale, but they will tell you that this is the lump sum consideration without assigning the values to the individual assets and liabilities, whether that is also a case of a slump sale, yes, that's a definition of slump sale, isn't it? The following information relates to software unit on transfer date. The purchaser of the S Limited is the purchaser, students. Students, S Limited is the purchaser of the software unit. And this S Limited, students, is an Indian company. Okay. So who is the purchaser? S Limited. And what he is purchasing? He is purchasing undertaking. Which undertaking? Software unit. Who owns software unit? PQR Limited. Before the slump sale, who is owning? PQR Limited. Now, students, be careful. Be careful. Now, this S Limited, which is the buyer, students, this S Limited, which is the buyer of the software unit, holds 74% of equity share capital of PQR Limited. He is holding what? 74% of equity share capital of PQR Limited. Fine. So you have to calculate the LTCG. That is point number one. And point number two, also advise whether a restructuring before the transfer can make the transfer tax neutral. Tax neutral means, because is there any way to do a restructuring of this entire transaction so that you can get a kind of a tax saving? Can you do a kind of a restructuring without changing the economic recipient of the software unit? Who is the economic recipient? PQR Limited. Sorry, S Limited. S Limited is the buyer. Who is the seller? PQR Limited. What PQR Limited is selling? They are selling one of the unit, which is software unit, to S Limited. What is the other data given to you in the question? Other data given to you in the question is S Limited, being the buyer, is holding 74% equity in PQR Limited. Now you are also asked, apart from the calculation of capital gains, you are also asked how you can make this tax neutral without changing the economic reality of this entire transaction. What can be done, students, so as to make it more tax friendly? What can be done in this question? Make a try, students. Whatever comes in your mind. So the assessee wants to do a tax saving. Who is assessee here? The transferor, on whom there would be a capital gains charge. Who is the transferor here, students? The transferor here is Indeed, students. The PQR Limited. And why you are saying so, Kanaiya? What is the reason why you are saying so? That Indeed is a... Just I need a confirmation. Otherwise, you have hit bang on the target. Why you are saying so? Quickly, do you have voice facility, Kanaya? You also can join through voice note.
Hello,
Yeah, Kanaya, please say.
am I audible, sir?
Yeah, perfect audible.
Sir, in under section 70, if we can see that any transfer between subsidiary and holding company to 100% wholly owned subsidiary. So here, sir, 74% share is already been taken by the company. And if they take 26%, in that case, any transfer would not be treated as capital transaction.
Excellent, Kanaya. Excellent. Very good. Very good. Excellent. That is exactly what this is what it is. Perfect. This is, students, exactly how it. See, this is a hint. Now, in the last lecture, students, if you remember the sequence in which we learned, I deliberately did the holding and subsidiary company first. so that any transfer of the capital asset from the holding company to its wholly owned subsidiary or vice versa is not a taxable transfer, students. Is not a taxable transfer. But for that, students, I told you one exception. So I told you one condition. The condition is that the receiving company should be an Indian company. I told you that the receiving company, students, should be an Indian company. Here, who is the receiving company? PQR Limited. In that context, sorry, S Limited. PQR is a selling company. Receiving company is S Limited. Is S Limited in this question just now I read with all of you? Is it an Indian company? Answer is yes. Whether the benefit will it be available? Answer is yes. So what they should do, students, what they should do is that what you should advise. See, you are a tax consultant. You have to advise this SSC. So what you should advise that you should tell PQR that let S Limited, your seller, who is already holding 74%, tell him before, tell him what? Before this transfer of slum sale, transfer of undertaking through slum sale, tell him before doing before purchase, what he should do? He should acquire another 26%. Once he acquire another 26%, it will make a case of 100% wholly subsidiary. PQR Limited will become 100% wholly subsidiary. And the moment it becomes 100% wholly subsidiary, then your game is now you can easily, then you can easily do this one. Now you can do the transfer. Now you do the transfer. After it has become a wholly owned subsidiary, now you do the transfer. And once the transfer takes place, what happens? It will not be considered as a taxable transfer. Yes, you may say, but sir, there are additional condition of that 8 years. Two conditions have to be seen. Those are there. But immediately, if you want to claim an exemption with this data, this is the best particular advice, students, that you can give. Is that point clear to all of you, students? Please confirm. Radha, clear?
Yes, sir. Ultimately, slum sale is happening, so you can straight away acquire other 26%. That is the logic which I got.
26%. Yeah. Perfect.
Sir, I have a question, sir.
Please say.
Sir, do the watches comes under jewelry? Because branded
Yeah,
watches,
yeah.
they
So
are.
that's a good question. That depends upon, like, for example, there are people who have got the gold jewelry and all, diamond embedded in that. So those per se, if you see those kind of watches with having the diamond being embedded on those things, by default, that cannot only be considered as a plain watches. And in this case, these are the diamond embedded, diamond finished, or gold. In this case, the real gold, those would be kind of a jewelries which will be there. It cannot be considered as a plain particular watch. So what we have to do in such particular case, whenever this issue comes, our thinking approach is about the substance over the form. So in substance, what exactly in this context was? The form, maybe you can say it is a watch. But in substance, students, for a watch, when you say how much could be the value in this case? Yes, at the most, we have a highest brand, which is a Swiss brand, Swiss watches in this case, which has got the finest technology. Because of this technology of the Swiss watch is what commands premium. This is the highest category. But beyond that, say of 10 crore watch in this case, then what exactly it is? These are customized made watches. And these are customized made watches because of what factor? Because of the jewelry factors. That makes the value, not the technology factor, but the jewelry factor. If technology is a factor, then yes, it is a watch. If jewelry is the factor of its value, then it is a jewelry. Is that clear, Kaliya?
Yes, sir. Yes, sir. Thank
Perfect.
you, sir.
Perfect. Students, now let's come to the next particular part. Now, before students, I go to the next part. Students, now here is the case. I just want you, the last particular slide, students, the previous class in which I showed you the slide, students. The first note, I think, students, I think all the notes are now being given. You already have got it, isn't it? And I think that the notes should be delivered, students, to all of you from time to time. Don't worry. In advance. Now, so this was our first class notes, which was in there, charging section, capital asset and all, and some thing that we did. Students, here in the first notes, let me take you through to this. I'll ask you this question because it's not that you are not aware of it. In your inter CA or earlier, or even if you have to apply a common sense, students, you will be in a position to crack it. Don't worry. So, students, capital asset we also did about this 12 months and 24 months, the period of holding. Today, we added to this period of holding one more, which is of slump sale of that business undertaking. It has to be 36 months. That has to be considered. Now, students, in certain cases, period of holding, students, this, so in this particular part, always ensure to read this one out. Always, students, ensure to read this one out. In this particular topic, students, right now 70 to 75% we will be discussing some areas like GDR and all. In NR taxation, whenever it will hit on, that time only this concept you will appreciate it. So right now we'll exclude those things. Otherwise we'll lose the charm when we do the NR taxation at that time. Let me start off, students, with the basic thing that I am quite confident that you are aware of it. Let me give you the flavor in this regard. Students, over here, students, let me give you a particular situation wherein, supposingly, if you can recall, students, say for example, the father in this case, the father, students, in this regard, he has a capital asset, and the capital asset, say, is of rupees 100. The capital asset, students, is that of rupees 100. Father was having a capital asset. The capital asset, students, is of rupees 100. Say for any reason whatsoever, because of the death of the father, or through will, or through gift, it came to the son. Students, okay. So, on account of inheritance, on account of will, on account of gift, son got the asset. Fine. So now in that situation, students, let me tell you, this father has held the asset from say year 0 to year number 2. And that asset happens to be say land. Generally, the immobile properties and some properties like jewelries and all comes through inheritance. That is generally the trend that we see in India at least. Then what happens once the property has been received by the son is transferring this particular asset outside. In year 3 itself, they have transferred it. Students, this thing you are aware of it, that if the asset is received on account of gift, will, inheritance, succession, that will not be considered as a transfer, students. That will not be considered a taxable transfer. Old section was 47, new section is section 70 that you people are doing right now. So this particular thing is covered under section 70. So therefore, if it is covered under section 70, not a taxable transfer. Not a taxable transfer, students. Isn't it? Not a taxable transfer. Okay. So therefore, father, when he has transferred the asset to his son, it was not a taxable transfer. Now, when the son is selling, he has transferred, say, at rupees 300. So, once the son is transferring, say, outside, he has transferred it at rupees 300. Now, at that particular point of time, students, you know what is the full value of consideration. Now, son is the one who will be the SSE. Yes, he is the SSE. And accordingly, the full value of consideration, students, you know it is 300 in that context. Now, what is the cost over here? What will be the cost in this particular case? Knowing the fact that the transfer from father to son was not considered to be a taxable transfer. The transfer from father to son was not considered to be a taxable transfer. The question to all of you is, when the son has subsequently transferred the asset, at that time, the capital gains will be computed in the hands of the son. Full value of consideration is the consideration that he has received. What is the cost in the hands of the son in that regard? So two options. The cost is the fair market value of the asset when the son has acquired the asset from his father. The fair market value of the asset when the son has acquired the asset, or it is the cost to the previous owner, or it is the cost to the previous owner. What it is, friends? What it is, quickly. Can you use the mic if it is possible? Is the cost the fair market value?
Sir, in that case, sir, hello.
Yeah, please say
Sir, in
kindly.
that case, the cost will be the cost of the previous owner, means the father.
Rather, isn't it? And why we are taking now, be careful, students. Here, this much value of gain that has happened, this much value of the gain was not taxable originally, isn't it? And if supposedly you want to start the cost, somebody if says, for example, rather if you say, if one says that I will start with the cost, uh, I will start the cost at the value of the asset at the time when the son has acquired the asset. That will be my cost. So if you are starting the cost from here, say for example the fair market value was 175, then you can say that to the extent of 75, that has escaped the taxation. That has escaped the taxation, and therefore to avoid a non-taxation, or may I say a double non-taxation. Yesterday, students, did you remember in the previous class what I taught you? Because of the double taxation, we were referring the cost as the fair market value. Remember that particular example? Kanaiya Radha. That example which we were discussing, that 1000 was the fair market value of the asset. Thereafter, what was reduced was the dividend. Dividend was, say, 40 was dividend. And therefore, my full value of consideration was 60. That was my full value of consideration. And from the full value of consideration, I reduced the cost of the shares. I'm talking about the liquidation particular example. The liquidation example, cost of the shares. And whatever was the cost of the shares, and balance was my capital gain, students. The balance was my capital gains. This is how I have determined my capital gains. So fair market value of the asset received, minus of that fair market value, portion of the amount was a dividend. Portion of the amount was dividend. The balance amount was a full value of consideration for the capital gains computation in respect of the shares. And I reduced the cost, which is whatever be the cost, and balance for the capital gains. Then I asked you a question, students, over there. Recall the last lecture. And my question was on the subsequent transfer. On the subsequent transfer, what will be on the subsequent transfer, students? What will be my cost on the subsequent transfer? Supposing that asset which I received on liquidation, when I am transferring that asset subsequently, then what should be my cost? Then at that time, students, you people have told me, sir, the cost should be 60. And I corrected you at that stage. I said that, no, students, it is not 60. The cost will be 100. And why I told you that? Because I told you that 60 as a cost is already 60 as the amount is already taxed under the capital gains, whereas 40 as a dividend is already taxed under the IFOS. So if you take 60 as a cost, then your capital gain will increase. And then 40 would be tax additionally, extra tax will happen on 40. Didn't I told you that particular thing? And therefore on the subsequent transfer of the asset, the fair market value is what has to be taken so as to avoid double taxation. Because you people said 60. So if you say 60, then your capital gain will increase to the extent of 40 more. Because if you start with the cost at this, then 40 more. Then can I say 40 is doubly taxed? There is a double taxation of 40 because 40 earlier it was already taxed in IFOS. 40 now again it is getting taxed. So that was a double taxation example. Here, what we are discussing right now is that father, when he has transferred the asset to the son, at that particular point of time, what at that time did the father paid any tax on that increase that has happened on account of such transfer? No. Why? Because he was protected under Section 70. He was protected under Section 70. And therefore he didn't pay any tax. Then when the son, subsequently that asset is transferred by the son, then the question is, what will be the cost in the hands of the son? So therefore the question is, what is the cost? Whether it will be the cost to the father or it will be the fair market value of the asset when the son has received the asset. It is the cost to the father, which is the previous owner. Why? Why we are taking cost to the previous owner? Because if we take 175, if we take the fair market value, then this much of the amount will become double non-taxation, neither tax in the hands of father nor tax in the hands of son. So as to avoid double non-taxation, I take cost as what? Cost to the previous owner. Cost to previous owner, students. So as to avoid double non-taxation, the cost to the previous owner as a concept has been introduced. The cost of the previous owner. So students, as a thumb rule, I'll tell you one important point of investigation. Just a second. Let me give first. And then it is 275. Then balance is 275. Now let me still ask you the question before we conclude. Tell me, students, the nature of capital asset. Students, tell me the nature of capital asset. In determining the nature of capital asset, long term or short term, the period of holding has to be considered. In this case. So the period of holding, students, please tell me, would be considered from the date when the son has acquired the property, that is year 2 to year 3. That would be the period of holding, that is what you will consider. Or the period of holding will go from the date when the father has acquired the property. Or it will be considered as a period of holding when the father has acquired the property. So students, just apply the logic. If the cost is that of the previous owner, so the date also should start from the date when the previous owner has acquired the property. It cannot happen. The cost is from the previous owner and the date is from when the son has received the asset. So whenever you step back, whenever you are stepping back means, like in this example, cost to the previous owner. Step back. Okay. So when you are stepping back, when you are saying cost to the previous owner, in this case, then even the date has to be counted from previous owner. Even the date has to be counted from previous owner to determine the nature of the capital asset. And accordingly, tell me, students, in this particular case, cost to the previous owner, date also should be considered from the previous owner. So whenever there is a concept of cost which you are stepping back, the date would also step back. The date also will step back. And on that basis, you will decide whether it is a long-term or a short-term capital asset. So tell me, students, now in this example, is it long-term or short-term? It is indeed. Now you will say, sir, in that case, from year 0 to year 3. And if it is from year 0 to year 3, students, how many years? 3 years. So therefore, it is 3 years. So 3 years means long-term. So it will be considered as a long-term capital gain. It's a long-term capital asset, and accordingly, it will be a long-term capital gains. Is that point clear to all of you, students? See, this is how you have to remember. I know that the provision, students, provision does not tell you the logic. Provision is only provision. But if you don't think about it, in that case, then it becomes a burden, and that burden, students, you realize it much later in this case. So understand that why we are saying why there is a cost to the previous owner. The reason is cost to the previous owner because the previous owner has not paid the tax when he did the transfer. Why the previous owner did not pay the tax? Because he was covered under section 70. Therefore, on his transfer, he didn't pay tax. And accordingly, on the subsequent transfer, whenever it happens, the subsequent transferor will compute the capital gains. And while computing the capital gains, the cost that he will take will be a step back. And if the cost is that of the previous owner or the previous transaction, then even the date also would be of the previous owner or the previous transaction. And that is how the clubbing of period of holding would be done. Is that point clear to all of you students?
Yes, sir. I have a doubt, sir.
Yes, sir.
Sir, is there any provision left for the indexation in this case, sir?
Yeah, indexation is there. Now. I'll just in the next class I'll move the case of the immovable property. Indexation is there.
Okay,
But indexation I'm just trying to avoid. Just let's first try to take all the concept in our hand, and once that is done, then we enter into the indexation era. Okay, and then we'll
okay, sir.
have the certain issues on that. Indexation is there. Immovable property has their option. So immovable property has the option of the indexation. Okay, only immovable property.
Okay, sir. Thank you.
Okay, and that particular thing that you, what if I can understand, your thinking is going to one case law, and that case law is that Manjula Shah's case law. Indexation, sir, will happen from the year when the son has acquired the property or when the father has acquired the property. That indexation part, isn't it? So that could be
Right,
your
sir.
personal query, is what I'm anticipating. That I'll address it when I touch upon the indexation part. Please repeat that particular query at that stage also. Okay.
Yeah. Thank you, sir. Thank you.
Perfect. Radha, what about you?
Sir, LTCG amount is incorrect. Just correct it to 225. And another one, with regards to indexation, I read in the section
Yes.
property acquired before 2024, July
Perfect. Perfect.
2024.
Perfect.
So
Perfect.
that was the thing which we need to consider to give
Yeah, yeah,
maximum benefit.
definitely.
And
That's the
sir,
reason
I
why
was
I'm
really
deliberately using year 0 and year 3 not to touch
correct.
upon this because that real estate when I hit upon, then I start the year itself. So I'm just
But sir,
playing on safer side for a time being. Yeah.
I was really scared referring to section 70 till ZL provision, sir. Amalgamation was totally unclear. I was like, do we need to learn this much things in section 70 itself?
So 70, what you will do now that's a trick. Herein, let's first do this particular part, and then this is the reason. That's why came to this particular part now. Now you see this particular thing. See over here, now just answering to that particular part, not everything. You will remember the way it has been, just only the class documents which I've given. See, there are the entire act, if you see, technically speaking, many things are transaction specific or particular transactions are being catered. So at our as a students level, we don't have to be transactional in this case. We have to take into account the entire whatever are the principal base, more like this thing. So transactional areas which are being given on these cases, we can just skip this particular part. So that's the reason why this class notes becomes important. That scare that you had, that whether entire list needs to be remembered, and the answer is no for that reason. So just have a look over here. Now what I've
Yeah.
done, if you see rather here in this case, see here what I have created this period of holding, which is section 206, read with this rule 6. Now here if you see, in one case period is excluded. See, I have created a category. Which is the category? The category is this, and this is what I'm just considering right now in this context. And also I'm considering rule number 6 at this stage. In this regard. In point number C, what I'm doing is that I'm just here in this context over here. In fact, point number D also you can just tick mark. And I think that should not be the issue. This point number C, except for the last one, GDR, because GDR and not taxation, except for GDR students, this you can easily crack it. Common sense. You will come to know. Don't worry. So let's do the first one, students. This is an important part. What is the period which is excluded, students, over here? Shares in a company in liquidation. So, students, if you remember, in our example only, I was giving the example right now. Last lecture, we did the example, isn't it? Shares in a company in liquidation. So, students, I am a shareholder of the company. And then, students, I have acquired the shares in, say, year 0. By year 3, the company went into liquidation. Okay. However, in year 4 only, the liquidator, I received the amount. Received the amount in year number 4. So, one thing I will say that once the company is liquidated, students, in this context, although the amount may have been received later on, so what they are saying, period of holding, shall I consider from year 0 to year 3? Or should I consider from year 3 to year 4, from year 0 to year 4? Students, didn't I told you period of holding as a capital asset? Tell me, after liquidation, does the capital asset survive? After liquidation of company, does the capital asset, what are the capital asset? Shares. In this case, the capital asset is shares. Does the capital asset survive in this example? And the answer is no. I told you in the first class. What I told you? Period of holding as a capital asset. After liquidation, capital asset doesn't survive. So therefore, what the law says, see here, apply the logic, students. Students, my humble request is that this lecture, Radha, Priya, and all the students, please repeat up, because this is lecture more principle based. This principle, if you easily you can digest this principle, what we are learning, many things, 80% of the things, students, you will know that, yeah, if you are taking this, the logic is this. If you are taking this, the logic is this. This is how you have to tell. You don't have, otherwise you will try to only end up remembering it, which will would be so much of burden on you. Whereas you have to learn it through the principal approach. Okay. So now you tell me, shares in liquidation, year 0 to year 3. After year 3, the capital asset will cease to exist. And that is the reason why there is no period of holding thereafter. And hence, the period from 3 to 4 is excluded. So this is what is point number A. Clear to all of you, students? Point number
Sir,
B, students. Yeah.
but in the liquidation, when it goes to liquidator, the piece in the piecemeal portions only that capital asset will be transferred now, sir. Technically, if we see in that angle.
Yeah.
So now, so that's why it depends on when the liquidator is transferring. So till that time, the transfer is not done now. That's what I was thinking upon.
Transfer, you have to say, see, one thing, you're talking from the angle of the shareholder. I am a shareholder of a company. The company has went into liquidation. It is certified by the court, liquidated from, say, 25th of May. After that, the liquidator has to then distribute the assets of the company along with the money that the company has. But through the court order, say 25th of May, the company is liquidated. After liquidation, I have got only a right to receive. But does the share exist post 25th of May? Answer is no. So therefore, when you have to calculate the period of holding for the shares, you are calculating what? Period of holding of the shares. Does the share survive after 25th of May? No. Shares only after liquidation. The company doesn't survive. The amount that I am receiving from the liquidator is just because of the whatever is the calculation that has happened. That he is to pay off primarily. And that is what happens from year 3 to year 4 is primarily the calculations and everything, how much to pay off, all these things is what is done. And finally, by the end of 4th year, I am paid my pro rata share. So when I will calculate my own pro rata share, when I'm going to calculate my capital gains, I need to know whether this is a long term or short term. Because what is that I have transferred? I, as a shareholder, when I'm calculating my capital gains, what is that I have transferred? I have transferred my shares at the time of liquidation. Because what is transfer? Extinguishment. kind of a thing. The share ceased to exist. And therefore, 68 is a specific chargeability which says that when you receive the amount from the company, then you calculate your capital gains. So I'll calculate my capital gains in year number 4. But the period of holding which I will consider would be only from year 0 to year 3 for the shares, because this amount that I'm receiving from the company on a pro rata basis, that I'm receiving because of the transfer of my shares. And the shares was held, period of holding, I have held the shares from year 0 to year 3. Because after that court order, once the company got liquidated, shares ceased to exist. And that is the reason why year 0 to year 3 is the period of holding, and that is the period for which the assessee will decide whether it is long term or short term. Any case, indexation is not available anymore in this context. So that is only for a limited purpose to decide the long term and short term. Please say.
Sir, in that case, sir, can we say that on 25th ownership diluted, and that's why my right also diluted and extinguished on the same day?
Oh.
So extinguishment of right happens on 25th. So whatever the assets held on that date, that will be considered for the calculation of period of holding.
Period of holding. Perfect. Correct.
Yes.
Radha, say.
Sir, I'm clear. Just one last query.
Please say.
Like, sir, certain parts of, as you said, about the amalgamation and stuff about the foreign company, that will be covered in NR taxation or in the capital gains itself?
This particular, we'll be doing amalgamation. In any case, we are doing it over here.
Because there is amalgamating foreign companies or the provision in the demergers and all.
But
I saw.
we are covering over here in the restructuring itself.
Okay, sir. Okay, sir.
Only for
Thank
a
you.
foreign
That's what
company, there is only a limited particular angle of 25%. This thing that will cover it up. That's not an issue.
Okay, sir.
So now, students, if you see other particular cases, now this is what it is: predecessor and earlier holding. Always now remember, this is the entire case of father to son example. You will now find, like, even the holding and subsidiary company. Let's take the example. Holding to subsidiary, last lecture we discussed. Is it covered in section 70? Yes. Okay. Now, if supposingly, so therefore, say holding has transferred to its wholly owned subsidiary. Say holding is father, subsidiary is son. Holding to subsidiary, when the capital asset was transferred, was it a taxable transfer? Answer is no, not a taxable transfer. Then on a subsequent transfer of this particular capital asset, what will happen? Whether the subsidiary company, when they do a subsequent transfer, what is the cost in the hands of the subsidiary? Cost to the father. That is the predecessor. Who is the predecessor? Holding company. And why we are taking that? Because the previous transaction was not a taxable transfer. And if we don't take the cost to the previous owner or the cost of the predecessor, then what will happen? Double non-taxation to the extent of that value. This is what we discussed, na? Double non-taxation to the extent of this value. And that exactly is the point. So what will be the cost in the hands of the subsidiary company, the subsequent transferor? It will be the cost of the predecessor. This is what will happen now. Now tell me, period of holding. Period of holding also needs to be calculated, isn't it? When the subsidiary company will subsequently transfer the asset, he needs to know whether the asset that I am transferring, is it long term or short term? Because long term capital gains, tax rate is different. Short term capital gains, the tax rate is different. So then, whether the subsidiary company, will he be clubbing the period of holding of the predecessor? Will he club the period of holding of the predecessor? And the answer is yes. Why? Same logic. If you take the cost backward, the date also will go backward. Did you all clear with this one? This is the principle. This is the principle. If the cost goes backward, date will also go backward. As simple as that. Is that point clear to all of you? Radha Kaniya? Cost goes backward, date also will go backward. That is all. And when the cost will go backward? When the previous transaction was not a taxable transfer. When the previous transaction is covered under section 70, and because of that reason, it was not a taxable transfer, then in future, Whenever there is a subsequent transfer that will take place, then the cost in that subsequent transfer will go backward. And if the cost goes backward, the date will also go backward to decide the nature of the capital asset. This is the fundamental thing you just can't afford to go wrong over here. And that is the reason why learn principally, students, rather than learn mechanically. Is that point clear to all of you, students now? Everyone? Perfect. Now let me come to the first category. This is the amalgamation. The amalgamation part. If you see over here, students, just take a 10 minutes break, students. And I assume that, students, if you can extend till 9:30, it's fine. Because then we can cover up this entire thing. Okay? Perfect. 10 minutes break. संकेत जी ब्रेक ले रहे हैं 10 मिनट का. So students, let's start on the amalgamation part now. On the amalgamation, students. So if you see over here, students, just have a look. Again, amalgamation. If you see first of all a definition, students, of the amalgamation, because not all the amalgamation students, there are two types of amalgamation, students, that you all are aware. I think in accounting there are two types of amalgamation. One is amalgamation in the nature of purchase, and the amalgamation in the nature of merger in accounting, isn't it? Question therefore is, in taxation, what amalgamation has been recognized? This is a very popular interview question, students, also. And unfortunately, students don't refer this very important definition of amalgamation. Now, I want all of you to refer this definition of amalgamation. And now tell me, under the income tax law, what amalgamation is covered? Amalgamation in the nature of purchase, or amalgamation in the nature of merger, or it is both? Read this definition of amalgamation and tell me. You would have got the hint, students, from the very first word, isn't it? Is a merger. Amalgamation is a merger of this thing. And also, even if they would not have written merger, students, I would have, even that word merger would not have been given. Still, I would have, going by the entire definition, I would have concluded that this is an amalgamation in the nature of merger in the income tax law. Why? See the definition. All the property of the amalgamating company becomes the property of the amalgamated company. All the property, if it is becoming the property of the amalgamated company, see the liabilities. All the liabilities becomes the liability of the amalgamated company. So this can happen only in the case of merger. Because if it is a purchase, then what happens? The amalgamated company will exercise the option not to take some of the assets or some of the liabilities that the amalgamating company will have to take care of. If it is a amalgamation in the nature of purchase, then it may so happen that the buying company, which is the amalgamated company, may not take some of the assets or some of the liabilities. So therefore, this is an amalgamation in the nature of merger in income tax law. There is no other amalgamation which is recognized. Other than that, the third condition that needs to be satisfied for amalgamation definition under the income tax law is the shareholder holding not less than 3/4 in the value of the relevant shares of the amalgamating company becomes the shareholder. So it is not the numbers, huh? This is the game. So there in Reliance Industry, there is one shareholder. He may be holding 3/4 of the value. In Reliance Industry, one shareholder may be holding 3/4 of the value of the share. Okay. And then there are some 1 lakh shareholder who are holding only balance. Balance how much? Balance 1/4. Balance 1/4. And what happens? Only that one shareholder becomes the shareholder in the amalgamated company. The remaining 1 lakh shareholder who holds the balance 1/4, they are not the shareholder of the amalgamated company. Whether the condition of this amalgamation under 2(6) is it satisfied? Whether the condition of this amalgamation under section 2(6) is it satisfied? And the answer is yes. It is not on the basis of the number of shareholders. The 3/4 as a proportion is not attached to the number of shareholder, it is attached to the value. I hope that all of you are clear with this one. Now, students, when we do amalgamation, as I told you, students, we always do integrated approach. In PGBP, just now we have seen there is certain provision which you people have read it in this case, which you have done it. I will be revising those provision here in this case and also the capital gains. So that integrated manner we will try to address the issue. We get a good opportunity. So let's try to use this opportunity to use amalgamation and deal in an integrated manner, because that is how you are also going to quote the question in the examination. So we be real now how you will get the question in the examination, and on that basis we will try to deal with it. Let's have a look, students. Capital gains. First, okay, the moment you see, students, the moment you see section 70 being referred, in this case, the moment you see section 70 being referred, it means not a taxable transfer, isn't it? That is what it will be. Now, students, over here, just pay attention. Just before we enter and start reading, who is making the transfer? Students, just pay attention to what I'm saying. Who is doing a transfer? Now, transfer is taking place at two levels. One at the company level, which is the amalgamating company. Amalgamating company is transferring its asset. So this is a transfer of the asset that amalgamating company is doing. So at first level is the entity level, which is the amalgamating company. They are transferring the asset. And the second level of transfer is taking place at the shareholder level also. Why? I am the shareholder of the amalgamating company. Now what I have to do? My shares will be exchanged with the shares of the amalgamated company. Now whether exchange, is it a transfer? Whether exchange is a transfer? And the answer is yes. So therefore, even a share at the shareholder level also, in the course of the amalgamation, students, at the shareholder level also, in the course of the amalgamation, transfer is taking place. The question is whether the benefit of 70, is it restricted to only the company, the transferor company, which is the amalgamating company, only to them that the benefit is restricted, or the benefit is also available to the shareholder of the amalgamating company who are also a transferor. Why? What they have transferred? They have transferred their shares in exchange of the shares of the amalgamated company. So whether 70 also covers them is the question. Let's have a look, students. So if you see over here, the first one, students, is at the entity level. Amalgamating company, they are transferring what? The assets, in this case, the assets, students. So this transfer is also covered in this regard. And the second category that you see is that of the shareholder is exchanging the shares. So does it cover at both the category? And the answer is yes. And that exactly is the point, students. And that exactly is the point. And this is all things has to be looked upon. So just read this particular part now, all of you. Just a second, read this particular part, all of you, in this regard, in this context. Now, students, in the first slide, students, which has been given to you, the previous notes. Now, the main condition, students, that you have to find out, just like the holding company, students, just like the holding company, if you see the first slide means the first class slide, 70 is there. The entire list of 70 I've given over there. Before the break, we were doing that only. The condition that has to be satisfied, students, in both the cases. What are the conditions? The condition, students, that is to be satisfied is that the amalgamated company, the buying company should be what? Should be an Indian company. This is one common condition, students, that you will always see. This is a common condition, students, that you will always see. And what is that common condition? The buying company, students, has to be an Indian company. Why? I told you the logic also when we were doing holding and subsidiary at that time. That there also the buying company should be an Indian company. Why? Because if you are an Indian company that is a resident, then subsequently when you transfer, that income will be taxable in your hands because you are a resident. So here also the buying company, which is the amalgamated company, should be an Indian company. That is the only requirement to be satisfied. So therefore, this is the requirement, students, in this case. Now, students, see the next one. Shareholder later sells. Students, tell me, shareholder is later selling the shares of the amalgamated company. Please tell me now. I am the shareholder of the amalgamating company originally. I have received the shares of the amalgamated company in exchange. I have received the shares of the amalgamated company in exchange. Then that amalgamated company, because it was an Indian company, that exchange of shares was not a taxable transfer. Subsequently, I have sold that shares of the amalgamated company. Subsequently, I sold the shares of the amalgamated company. Now you tell me, students, in this case, be careful. Huh? Supposingly, I'll just give an example, students. Let me see if you can crack this one. Say, for example, over here, students, this is a case wherein amalgamating company and the amalgamated company. Just a second, huh? Just a second. Let me redraft it. Students, so I acquire Mr. X. Mr. X acquired shares. Now here it was, say, 1st of Jan 2025 of X Limited. Now this X Limited is unlisted. Okay, unlisted company. Now somewhere on 1st of March 2026, amalgamation happened. And in this amalgamation, students, in this amalgamation, X Limited shares was exchanged. X Limited shares was exchanged to receive shares of Y Limited. Now, students, Y Limited is also, in this case, Y Limited is also unlisted company. Fine. Now, what happened in this case is that, students, on 1st of March 2027, here, Mr. X sold shares of Y Limited. 1st March 2027. So my question to all of you is whether the shares of Y Limited, is it long term or short term? This is the question. Whether shares of Y Limited, whether it would be considered to be a long term or a short term in this regard. Radha, Kariya?
Sir, at long term.
Long term, isn't it? Why you are saying so? Because you are
More than
clubbing.
24 months.
Yes. So you are clubbing the period of holding. Why you are clubbing the period of holding? Because the previous transaction was not a taxable transfer. Because the previous transaction was covered under Section 70, two things will happen. What will happen? The cost in the subsequent transfer will be the cost of the previous cost of the previous particular company shares. Step back. I told you now what is the term I use? Step back. So it is a step back cost. And if you are stepping back for cost, whether you have to step back for the date also? Yes. And by stepping back to the date, your date now exceed 24 months and therefore it is a long-term capital asset. I hope that all of you are clear with this one. Perfect, friends. So this is all, friends. The things has to be considered. Now I think now I'm confident. Now you have picked up the most important and the core issue of this particular part. So this is all this particular point has to be considered. Now, students, apart from that, let's see what are the other tax consequences that will be arising in this regard. Let's have a look quickly. So other than this one, students, okay, just before that, now, students, there can be a dissenting shareholder, no? Just hold on here. Students, shareholder will be getting exemption when? Exemption only when you are exchanging the shares against the shares. But can there be a dissenting shareholder? Yes. At least 1/4 of the value can be a dissenting shareholder. What if the dissenting shareholder, they don't want to become the shareholder of the amalgamated company? So if those 1/4 or less than 1/4, if they don't want to become the shareholder of the amalgamated company, they can encash. Means they can get the amount at the time of amalgamation. And if they are getting the amount at the time of amalgamation, whether that amount so received, will it be taxable? Yes. What is exempt or what is covered under Section 70 is exchange of share against your share. Exchange the shares of the amalgamated company against your shares of the amalgamating company. Only that is covered for the purpose of Section 70. Only condition that we have to see is that the amalgamated company whose shares you are receiving, the amalgamated company whose shares you are receiving, that amalgamated company should be an Indian company. Is that clear to all of you, students?
Sir, I have a question, sir.
Yeah.
Sir, while getting the shares from shares, sir, in that situation, if company X also receives some nominal amount, like shareholder also receive nominal amount with the
No,
share,
shares only exchange of shares. Kanaya, it is a strict. I am a shareholder. Okay, and I am exchanging my shares of the amalgamating company to receive the shares of the amalgamated company. Then,
right?
if I want to claim an exemption under Section 70, shares against shares, that's it. If you say, sir, shares, but I receive 100 rupees extra as a cash, then gone, condition not fulfilled. Full taxable.
Okay, okay.
Okay. Students, now let's come to this one, PGBP particular part. PGBP succession consequences. What will happen? If there is succession, what will be the consequence? Students, this thing we discussed in this particular part. Amalgamating company, students, now tell me, the assets will be transferred by the amalgamating company to the amalgamated company. It may so happen, students, that the amalgamating company, amalgamation may have happened, say for example, on 1st of July. Amalgamation may have happened, students, say on 1st of July 2026. Up to 30th of June, amalgamating company was using the assets. for its business. From 1st of July, it is the amalgamated company that is going to use the asset for their business. Now, the depreciation, students, as per the provision, what will be the impact of the depreciation? There would be a split of the depreciation amount. And how you are going to split the depreciation amount? This is what you do, students. Just pay attention. Students, you will calculate full depreciation of the asset of the amalgamating company for the entire year as if no amalgamation has taken place. You will claim full depreciation on that assets of the amalgamating company and forget that there is an amalgamation that has taken place. So forget that. Claim full year depreciation. And once you have claimed full year depreciation, then what you do? You do a split. Think logically. What do? Do a split. Split in the ratio of number of days the asset was used by amalgamating company and amalgamated company. That is it. So therefore, what you do, the split happens to the pro rata day by use. This is what you do. So this is one way. So the assets of the amalgamating company has been used both by amalgamating company and the amalgamated company. If this is the case, during the tax year, then you calculate full depreciation on that depreciable asset of the amalgamating company, and whatever is the total depreciation, you do the pro rata split. Why should it?
Sir, I have a question, sir. Sir, like during transfer of assets from amalgamating company to amalgamated company, there may be some pause. Like in that period, there may not be any use of that assets
Doesn't
by
matter.
the amalgam.
Doesn't matter. Doesn't matter. When you say use test, use cannot
Yes.
be everyday use. So therefore, few days the asset, in that case, even a passive use
Hmm.
will be sufficient. So there could be a pause. Yes, agreed, probably in this regard. But that if it is in the pursuance of amalgamation, in that situation, even that is a case of a use. That will see what will happen when there is an amalgamation. That does not mean the asset is going to get transferred somewhere else, because the factory building of the amalgamating company will become the factory building of the amalgamated company. So when there is an amalgamation taking place, don't get an impression that, sir, I'm going to transfer the plant to another site. You are not going to do that, because all the assets of the amalgamating company will become the assets of the amalgamated company. And if that is what you have to do, in that case, what will happen? The factory building will be the factory building. The plant and machinery will be the same site. So it is not that the production will be hampered in this case. It's just that there is a particular cutoff date. Probably after that, amalgamated company takes over. Yes, there could be some pause, but that pause does not imply that the asset was not in use. That is what it is.
Okay. Thanks, sir.
This part, students, also, rather, if you can recall, this part, I told you about these things. Remember the trick, the infirmity, I told you actual cost. What would be the actual cost on WDV in the hands of the amalgamated company? Remember, we are recalling that. So, the actual cost on the WDV in the hands of the amalgamated company would be the WDV. Obviously, it's a going concern. As it is where it is. I told you, till 30th of March, till 30th of June, it was amalgamating company. 1st of July, it became amalgamated company. And therefore, and the previous as transfer from amalgamating to amalgamated, previous transfer from amalgamating to amalgamated, was it a taxable transfer? No. So what is the cost in the hands of the amalgamated company? The cost in the hands of the amalgamated company will be the WDV of the amalgamating company. That is what they are trying to say. Is that clear to all officials? Fine. Then the amalgamation expenditure, students, that you can see. Students, if you remember all the amalgamation demerger expenses that happens, obviously there is a lot of expenditure happen. A court, you have to get a legal consultant. Then there are a lot of people who are involved during the amalgamation, lawyers and all also are involved. So there is a specific expenditure that is getting incurred for amalgamation. So that amount of the expenditure is allowed as deduction, students. And be careful. In 5 equal annual installment, can you see that? In 5 annual equal installment, students. So this is what exactly it is. So therefore, students, in 5 annual equal installment, students, that this particular deduction is taking place. I hope that all of you are clear with this for now. 1/5, not entirely. And who will be getting deduction? Obviously, it has to be amalgamated company. We have to apply our common sense here. It has to be, students, amalgamated company. Why amalgamated company? Because amalgamated company doesn't survive. What about VRS expenditure? Remember, now these are important points, students. If you remember, I taught you VRS versus retrenchment compensation, and that when we are doing employee basis deduction, you may have taken also in your notes. And at that time, I told you VRS is allowed as deduction for 1/5. Supposedly, the company has given a VRS to its employees. So 1/5 of the VRS amount paid is allowed as deduction in the hands of the company. Supposedly, 1/5 is allowed. Supposedly, after 2 years, the company goes in amalgamation. Company goes in amalgamation, students, after 2 years, which means 3/5 of the VRS is still pending. 3/5 of the VRS is still pending, students. Question therefore is whether the 3/5 will that be allowed again to the amalgamated company? Yes. So the balance 3 years, which is left, one third, that equally that will be allowed for the balance period. It will be allowed in the hands of the amalgamated company. So this kind of amalgamation in the case of a merger, can you see the theme, what the government is trying to do? See the from definition, you should read up till here. And you will come to know the theme is very clear. A continuity. A continuity. There is no disruption. It's a plain continuity that we are saying. Let's extend the example for the students. Brought for business loss. Amalgamating company, say for example, out of 8 years, 3 years loss, they have 3 years carry forward has happened, but the loss is still to be set off completely. 3 years carry forward, students, has happened, but the loss is still to be set off completely. And for what has happened in the 4th year, amalgamation happened. So whether the amalgamated company will they be eligible for the brought forward for the remaining 4 years? Answer is yes, they are. Answer is yes, they are, friends. And that is what you can see over here in this context. Can you see this, friends? So here, in this particular context, accumulated business loss, UAD. By the way, students, you know, for UAD, do we have any time limit to carry forward UAD?
Yeah, it is for infinite years.
Infinite years, Radha. So supposedly, amalgamating company has some UAD. Amalgamating company has got some UAD. UAD is still unabsorbed. Now, if it is for infinite years for the amalgamating company, whether the same continuity will that be there for amalgamated company also? Answer is yes. See the theme, continuity, because it is a merger. It's a merger, means like a marriage. It's not a purchase. Merger means all assets, all liability. That exactly is the continuity. So students, this is what it is in this context. Now then, yeah. Now students, what I have done in order to avoid the repetition, this what we learned right now. Amalgamation, demerger, company to LLP, conversion of a company into a LLP, or conversion of a firm or a proprietorship concern into a company, you will find, avoid duplication, and you'll find that all this is contained in the whatever we discussed just now. I have told you that look, this is contained over here also. So you have to do one thing thoroughly, students. And once you do one thing thoroughly, everything probably becomes easier now. Now let's students try to take a practical problem, because nothing happens without the practical problem. Let's have a look, students. Practical problem, students, on this. Comprehensive practical problem, students. I told you integrated approach is our theme. Mendova Laboratories Limited, an Indian company owning an industrial undertaking, engaged in manufacture of pharmaceuticals, amalgamates with Cure Generation Limited, an Indian company, under a scheme effective 1st October 2026. So amalgamation has taken place on 1st October 2026. The following facts are given. All properties and liabilities of Mendova immediately before amalgamation becomes property and liabilities of CureGen. Shareholder holding 82%, we require 75% in value, students. So amalgamation conditions are getting satisfied. Yes, it is an amalgamation in the nature of merger, and minimum three-fourth of the value of the shareholder of the amalgamating company should become the shareholder of the amalgamated company when that condition is getting satisfied. So that condition, students, is done. By the way, students, be careful. Huh? The amalgamated company has to be an Indian company. So it is an Indian company. Please don't take your eyes off from that. Huh? Let's take the next one. Point number 2. It's the same question, extended point. Same question, extended point. So, student, this was an examination question, the old question. It had only 4 adjustment. I put another 4 just to make it comprehensive because so that all the adjustments are at one place, students. All the adjustments are at one place. Please see point number 2. Mendova had carried on manufacturing business for 6 years. On the amalgamation date, it satisfies the requirement of continuously holding at least three-fourths of the book value of the fixed asset held by it for 2 years. Students, this condition is a condition which is you are going to learn in set off. Just for the sake of making it comprehensive that I have done this condition, okay? But this condition you learn in set off because then you will do your final revision examination. So that time you'll appreciate that this condition is relating to which topic? Set off topic. But I've just kept it so that let's ensuring that in your revision you'll really appreciate the integration that has happened. Okay. Right now, for at this point of time, just think that amalgamation conditions are getting satisfied. That much you just need to appreciate. Let's come to point number 3. Mendova opening WDV of plant block for tax year 26-27 is how much? 12 crore. That is amalgamating companies OPWV is how much? 12 crore. Depreciation for the entire tax year had no amalgamation occurred. How much it is? 1.8 crores. For the purpose of the problem, assume the plant is used by Mendova for 183 days and CureGen for 182 days. So they have already given pro rata bit truth. Point number 4. Mendova has an accumulated non-speculation business loss. That is, amalgamating company has an accumulated non-speculation business loss of how much? 3.6 crore. First computed in tax year 22-23. So tax year 22-23, 23-24, tax year 24-25, 25-26. 4 years is already over. Tax year 26-27 is the 5th year. So 5th, 6th, 7th, 8th, still 4 years paid there. So will this be allowed? Balance 4 years. Will this be allowed to the amalgamated company? The answer is yes. What about UAD of 1.2 crore students? UAD of 1.2 crores
Yeah, it is eligible, sir.
carry forward by the amalgamated company for unlimited year, isn't it? Perfect, very good. Point number 5. In tax year 24-25, that is last to last year, Mendova paid 1 crore under the qualifying VRS and had already been allowed 2 installment is done. So 20 lakhs each. So 40 lakhs is done. Remaining 60 lakhs is still left. Balance 3 years is still left. So 20 lakhs each for the balance 3 years. Starting from tax year 26-27, will it be available to the amalgamated company? Answer is yes. Point number 6, CureGen incurs 60 lakhs wholly and exclusively for the purpose of amalgamation. So can you see that this is the amalgamation related expenditure? 60 lakhs. So this 60 lakhs is 1/5 will be allowed to the amalgamated company for that 5 years period. Point number 7, Mr. P acquired 12,000 Mendova shares. That is the shareholder of the amalgamating company. When he has acquired? June 2022. For how much? 36 lakhs. Under the scheme, he receives only 8,000 shares. This is to answer your question, Kanaya. He receives only 8,000 shares. If he would have received shares plus cash, 70 would not have been applicable to P. Now their market value or allotment, Kanaya, is 64 lakhs. Does it matter? No. Why does it matter? Because at the time of exchange, it is not a taxable transfer. So at the time of exchange, what was the market value? How does it matter? It doesn't matter. Now he is selling all the shares in March 2027. 72 lakhs. Tell me, then in that case, October 2026, amalgamation happened. So October 2026, he would have received the shares of the amalgamated company. In the next 6 months, he sells the shares of the amalgamated company. Is the shares sold of the amalgamated company by Mr. P, is it a long-term capital asset or a short-term capital asset? What is your take, Shruts?
Sir, long term, sir.
Long-term, why? Cost you are going backdated, isn't
Yes,
it?
sir. Yes, sir.
If the cost
Yeah,
you are
because
going
in June 2022, P had acquired, so
that way.
that is the
So if
reason.
the cost you are going backdated and the cost would be 36 lakhs, even the date will have to be backdated. So from June 2022 to March 2027, 5 years long term. That's it. Mr. D, a descending shareholder. Students, he receives 18 lakhs cash. He does not want the shares of the amalgamated company. Descent. What are you going to say? Cash out, pay the capital gains. It is taxable. Students, now we have already discussed. Can you now go through the solution part? I've already discussed each and everything. So what I've done, students, is that I'll tell you what trick I have played. These were various adjustments or various attempts. I have consolidated this in one place only. Are you getting this one? These were all the adjustments in of various attempts. So what I've done is that I've consolidated all the adjustments and I've put it over here. So you will not get the question like this, by the way. Okay, like this kind of a question. But this, you know, this is how all the adjustments you will have to solve in this case. Now I think I have already discussed the solution. So that is it in this context. Now students, now then, what's the time, by the way? Now, if you see over here, one assignment, students, I will just leave it for you, would be the succession and the conversion. So that in the next class, we will do the demerger part and that foreign company, which rather you're talking about it. The foreign company demerger and the foreign company amalgamation. So, and then the real estate transactions will be touching upon on that particular part. Okay, now just one thing I'll just give you, students, here. If you see, just now I have already told you, students, if you would have seen, just now I have already told you that it is like a verbatim mirror image. Did you realize that thing, students? Just a second. Huh? Just a second. So, students, what will happen in this case? There is this two particular part, two more succession. Although this doesn't generally you don't target in the examination, but still you learn at one place thoroughly. You learn in all the place, as simple as that. Because all the provisions are same. That's the reason why I made that grid. That these provisions that you are learning here, is it same for demerger, for amalgamation, for conversion, for succession? So that is the reason why I made that grid, which I just showed you while we were doing this particular part. So students, the other particular part of the restructuring which you see in this case, succession, conversion, what exactly it is, by the way. So say for example, a particular company, a firm, say for example, students, a firm is growing and it has become a company. Same thing, all the assets of the firm becomes the assets of the company. All the liability of the firm become the liability of the company. Those who were the partner, say for example, there were two partners. They receive the shares and not any other thing. They receive what? They become the shareholder. Now they become the shareholder in the same proportion in which they were having the partnership share in that particular firm. So if the firm satisfies these conditions, if the firm is satisfied to this condition, then what will happen? The transfer that has taken place by the partnership firm to the company, this will not be considered as a taxable transfer. Why? All the assets, all the liability, it's again a merger, na? Just a succession from a, don't use the word merger because merger term we use for amalgamation, but just like a merger only, all my assets, all my liability is now of that to the company. The shares which was being there is received by the firm, by the partners in the same proportion in which they held the profit, PSR ratio. So what will happen? Whatever assets which has been transferred from this firm, whether the firm will enjoy Section 70 exemption, and the answer is yes. Only condition, this has to be an Indian company. This has to be Indian company. Same thing. And rest all what we discussed is the same. Now, other than that, there is one more particular point. From private company, there is a conversion into LLP. Students, you may be aware of this one. Private company into LLP. So now with LLP form, many times what happens is that, see, I have become a company, but I'm not viable to be operated as a company because my turnover is very less. Possible? Because you are having a very less turnover, very low turnover, plus your asset size is also very less. You should not have operated as a company because for a company, students, you know, there is 100 compliances that they have to do. Companies Act, books, AGM minutes, register, so on and so forth. Standards. So the compliance weight or the compliance cost will outweigh your own profit that you earn, and the company will go for a liquidation. So therefore, just to ensure a viability or feasibility of their operation, that they survive and they can do this particular, they can do their business operation without much of burden of compliance, that the route of conversion has been created. What is the conversion route? That the private company will be converted into LLP. Is it for all the private company? No, it is only for the small companies. What is the definition of small company? Small from the angle of their turnover, small from the angle of their asset size. This is the definition of small private company. Small from the angle of the turnover, small from the angle of their asset size. That is the definition of small company. So small private company, probably they can convert themselves into LLP. Now, obviously, again the same thing. What is happening? All the transfers are happening. All the assets of the private company becomes the assets of the LLP. All the liabilities, so on and so forth. Whether whatever you have learned just now, whether that will continue to apply? And the answer is yes. That's the reason why that chart becomes important, students. That grid. Same provision. And that is the reason why, students, I just want you as an assignment, probably for the succession and for the this one. Just read and be ready for this one. Radha, Kariya.
Yes, sir.
Okay, so that's exactly very manageable particular thing, very simple particular part. Everything will be the same. And that's the reason why I think there in the examination also, amalgamation, demergers are something wherein I think we have seen many of the questions that has been put across, and that's the reason why I have next class when we do demerger students first, and then that foreign amalgamation and foreign demerger, which rather you were talking about it, we'll complete that, and then we enter into the case of capital gains implication on the real estate transactions. So entire real estate provisions which are there in the head capital gains will be deliberating on the same. Okay. Now shall I take up that particular query, Radha, that you are asking for?
Yes, sir. And your video is off, sir.
Unfortunately, I don't know what has happened, but
No issues,
unfortunately,
sir.
I hope that the screen is visible. Na?
Correct, correct.
Something
Screen is
has,
absolutely
yeah,
visible.
something, the light got flipped. Na? That is the reason why something has happened. I need to just, because it will take some time, but I think screen is visible, so that should be fine. So what I'll do here, I have, let us have the section itself. Now, the Bear Act, na, rather, I'll just share, because if you have the Bear Act right now, because through Bear Act it becomes easier. I'll just share you some this provision.
Yes, sir. Like after referring direct only, I got scared that this
No,
is too much technical things
no,
involved in that.
we will just, I'll make you understand something. If all students have the Bear Act, I'll just make you understand how to read this thing, because obviously when you when you have to speak, you might have to speak very carefully what to say, isn't it? So if you see, like for example, section number 2 over here, section number 2, section number 2, if you see definition, they say like this: in this act, unless the contest otherwise require. Okay, now after this, if you see now, this they do. This is the hint I'm giving you. It means this is the connector. If you have the Bear Act, just see whether you can see this one. The Bear Act itself. So, or else I'll just open up the Google itself instead of writing. Let me in fact just open up the Google part. So if you see students over here, so just have a look to this particular part. Now just over here, students, just can you see this one? Now what you can see over here, just to read this one carefully, see in this context. In this act, just section 2, in this act, unless the context otherwise requires, and then you see a dash. This is connecting now. So when you have this connector and then you have the things below. So what will be the case? The after connector, the things which comes below is a clause. You will have to read that as a clause. Because everything now, everything, the clause which is there will have the common particular header. They have to be read. Everything that you will read now below will have to be read vis-a-vis this main part. In this act, unless the context otherwise required. So this is my then dash. Dash is what? Connector. Connector to all the things below. So all the things below will have a common particular theme. And therefore the things below that will become a clause. They are not independent. They are all clause. We have done dividend, not deemed dividend we are doing other day. But what is the section 240?
240F.
Yeah, 240, isn't it? Dividend we are doing. So let's have a look. Dividend. So 240, 2 in the bracket 40, that 40 would be referred as clause. Because why clause? Because it is coming from that main particular part. The connector is already on that dash, and then below everything is this thing. Now just have a look. 40, 240 for the dividend. So now dividend students, just have a see here. Now 240, what is 40? Clause 240. Why? Because already that connector is already going on from the main section to first line. Connector is already on. Okay, so this 240, 240, 40 is a clause. Dividend includes. Now see, again the connector is happening. Is there a connector after includes? Yes. So what happens? That A, B, C, D all will be the subclause in this case. So therefore, this is how the things would be considered. Now let me give you something which is very independent. Charging sections. Like we did section 67, isn't it? Capital gain, since we are doing it. And since the section that we are doing it, so that at least those things we can quickly wrap it up. So let's take across section 67 is what we were doing just now. Na? 67 and 70 is what we were doing. So just a second.
It's around page 132, I guess. 67. Yeah.
Yeah. So now
Yes, yes.
just have a look. The charging section of capital gains. Now see here how it starts. What I'm going to say, 67 directly 1, subsection 1. This is referred as what? Subsection 1. Will I refer this bracket 1 as a clause? No. Why? Clause requires a connector above with a common thread. A thread has to be there, a sentence has to be there, and then after sentence, there has to be a connector dash. And below dash, the number should start. Then we say it's a clause. So what we get in the charging section 67, directly it starts with in the bracket 1. So what this 1 will be referred as? Subsection. Is that clear?
Yes, sir. Like I was just thinking, pondering upon that why this kind of clause and subsection bifurcations they are giving.
And then 70, let's say 70 since we are doing 70. Na? Since we are doing 70 now, just have a look. And in fact, we discussed 70 last lecture also. We made some important conclusions. But let's have a look to section 70. Here, 70, this would be subsection. Directly 1 is coming. So 70, directly 1 is coming. Subsection. Then what it is? The provision of section 67 shall not apply to transfer. The provision of section 67 shall not apply to transfer of. Now there is a dash. Dash means the connector is happening now. Connecting what? A, B, C, D. So whenever that would be there. So a connector is happening. After connector, A, B, C, D. So what I am going to say? A, B, C, D has a connector above. What is the connector? Connector says the provision of 67 shall not apply to transfer. So all A to everything, whatever we are discussing, till Zn, whatever it is, they have a common thread, a connector. And what is the common thread? The provision of section 67 shall not apply to transfer. Transfer of A or transfer of B or transfer of C. So that 67 charging section will not apply to A or B or C like that. So A, B, C, D has a common thread, and that common thread with the connector. So A, B, C, D will be referred as what? Clause. So the clause has a common thread above with the connector. What is the connector? Dash. This is what you identify, that whether you are reading a clause or whether you are reading a subsection. Is that clear to all of you?
Yes, sir. Like in dividend, you said, na, 2 clause, 40 subclause will be coming if connector is there. What if
Because, yeah,
connector
yeah.
wasn't there? Then was it be calling a subsection? Just
No,
I
no,
know
no,
it
no,
may
no, no,
sound
no. If it is a clause, after a clause, if clause already is a connector, na? After that
correct.
clause, already the main connector is there. So clause, therefore, there cannot be a subsection thereafter. In this context, there
Yes.
could be a subclause only and subclause. This is how it would be. It can never happen a subsection. Subsection means an independent entity, doesn't have any background of any connectors and all.
Yes, sir. I am clear with this that why the act is giving this kind of things like clause and all.
Yes, 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 yes. So therefore, the clauses are mainly to have some connector above. So you cannot read independently this. The main point is that subsection you can read independently. I can read 67(1) independently. 67(2) independently. Each of them are independently to be read. One will not influence other unless there are some qualifying words which are used in that section. Other than that, it will be read independently. But B cannot be read independently. B has to be read with the connector. And what is the connector? The provision of section 67 shall not apply to transfer of B. So you'll read this. So B cannot be read independently. C cannot be read independently. All have to be read through that common connector. This. So you will read like this. How you are going to read? If I have to read B, I will not read of a capital set of individual. No, I will read like this. The provision of section 67 shall not apply to transfer of a capital asset by an individual or HUF under the will or gift or irrevocable trust. This is how I am supposed to read. So as to make some sense out of it. So there is a connector, and then whatever you read now below, that below cannot be read independently. It has to be read with the connector.
Yes, sir. Got it. Like for example, in C it is given sub clause 1 and 2.
Exactly. So that is a subclause. That is a no. That is a subclause. So 70
Yes.
subsection 1. C is therefore referred as what? C will be referred as what? C is referred as a clause, and then 1 and 2 is a subclause.
Very clear, sir. Thank you so much.
Okay. Okay. Sure. Okay, students. Then
And take care of your health, sir.
yeah, yeah, a bit down actually today. Just that
Yes.
cold and bit of that is there. So that
Yes.
was only reason. Thank you. Thank you. Just
Assignment is for the succession only, na, sir?
only
Or any
succession
other?
and conversion, and slum sale you can just do it. Slum sale, that question, because we have already discussed it. Main was in slum sale that 76%, 24% part. That part.
Okay, sir. Okay, sir.
Okay. That you acquire another 26% before the slum sale so as to make that 100% category. Okay, you just do this for FMB1, FMB2 and the net worth. But just importantly, students, when you now solve, don't solve only FMB1, FMB2. Solve from that what the principle I taught you. What the principle I taught you? I taught you that, see, there is an attempt on the part of the legislature to enhance the consideration and to reduce your cost. And this I have proved it through my own example, through my own case study, how they are making an attempt to enhance the consideration and reduce the cost, and what they are going to achieve by that? Increase of the capital gains. Fine, friends?
Yes, sir. Thank you, sir. Very
Okay.
happy to do it. Thank you.
Take care. Bye. Good night to you. See you then on Saturday. Bye. Bye. Good night. कन्हैया बंद कर दीजिए आंखें जी.